Good afternoon. I again welcome all the participants today to this webinar. Let me first recognize presence of WRC Vice Chairman CA Vishal Doshi, Regional Council Member CA Drushti Desai, speakers for today's first two session CA Padmashri Crasto, and for the third session CA Vajantimala Belsare. Welcome to both the learned speaker.
Thank you.
At the outset, let me inform all the participants that although in the WRC newsletter we had planned daily program of 1.5 hours from 4 to 5:30, because of new guidelines which came up, we had to consolidate this 15 days program and merge into 5 programs, because we can do 5 events in 15 days, and hence we are having this 3 hours program every day. And yesterday there were 3 speakers, it went off quite well. And today I am a little less worried because there are only 2 speakers and both are already on, so which is a good thing. But other than this, we are also scheduling some other programs, so like jointly with some other organizations to utilize the balance date which we'll have. The one program with Bombay Chamber of Commerce and Industry is getting planned jointly with WIRC, and another with the Institute of Internauters Inc., a series on Internaut. So as we finalize, we'll inform the participants through bulk mail and also through WhatsApp. With that, let me now request WRC Vice Chairman Vishal Bhai to please give the opening remarks. Over to you, Vishal Bhai. We can't hear you. I think you are on mute, Vishal Bhai.
Sorry, my apologies. We'll have to get used to all these technologies now. So, good afternoon. Thank you, Murtaza Bhai. I recognize the presence of my council colleague, CA Drushti Desai, and I also welcome the speaker, CA Padmashri Krastro and CA Vajantimala Belsare. Friends, let me tell you, the topics that are to be discussed today are indeed really important. But before I come to that, let me inform that the first speaker for the day, CA Padmashri, and I have been working very closely for release of some of the WRC publications of last year. And let me tell you, we had a record-breaking 3 publications under the Corporate and Allied Laws and Corporate Governance Committee on CARO, on prevention of insider trading, and recently last month we launched was on key audit matters and SA 701, 5 and 6, where Padmashri has been a very, very good resource person, and she, on the contrary, I would say, she has been pushing me to ensure that we are able to release these publications for the benefit of members and students. So here I would like to recognize and appreciate her involvement and support, and thanks Padmashri for that. And we look forward for more support from you in the future. Friends, talking about the topics that are to be discussed today are about the important updates in the Companies Act 2013 during the financial year 1920. The next is on the audit report SA 701, and the third is on Ind AS 115. If I start in the reverse order, let me say Ind AS 115 is definitely important from the perspective of the COVID-19 effect also, because there might be a lot of returns, reversals, contracts might get impacted, and that is where the impact of 115 would become relevant from an auditor's perspective, and therefore it is very apt that we are discussing this standard today amongst all of us. As far as audit report is concerned, I am sure Padmashri would definitely touch upon the reporting that would be required in this scenario of COVID-19, especially with respect to be very honest, there are a lot of different views that are emerging when I'm interacting with different professionals. You know, that whether a particular impact would be covered in the key audit matters or would it be other matters, and with the necessary disclosure in the notes to account. And you know, even about going concern, if there is certain material uncertainty with respect to going concern, that has to get covered in the audit report. So these, I understand, are some very, very important aspects which as professionals we need to ensure. And what would happen is that, I don't know, but maybe March 20 audit reports would be the only report where we will need to cover these impacts, because hopefully by March 21 reporting, everything would be back to normal. So it is nothing like a normal thing. If I've left or overseen something in this year, I would correct it in my audit report in the next year. So that is where I feel that having a eminent speaker like Padma Shri would definitely help all of us. And definitely for the 115, we having experienced and knowledgeable speaker in Vaijantiwala madam, and definitely she would take us through the nuances of 115. So with this, I thank the speakers once again for sparing their time, and even in this lockdown situation, making presentations and coming before members to ensure that the learning continues. So thanks once again, and thank you, Murtuza bhai. Back to you.
So before I proceed ahead to introduce the speaker, I would request the WRC staff to play a small video on ethics. WRC has prepared a video on ethics, and every month we are going to prepare one new video covering few of the questions on ethics. Mishra ji, if you can play the video, please. Bear with us for 1 minute. And Mishra ji. Till the time Mishra ji tries to do that, let me take the opportunity to introduce the speaker. So Padma Shri is a partner.
Padma Shri tractor.
नहीं वो तो टेली डाउनलोड करना पड़ता है साइट से। हाँ करना पड़ेगा ना।
मिश्रा जी आप म्यूट तो करिए, मैं स्पीकर को इंट्रोड्यूस करता हूँ, कल ट्राई करेंगे वीडियो के बाद।
तो टेली सॉल्यूशन की साइट पे जाना है आपको, telisolution.com। हाँ telisolution.com पे जाएंगे ना, वहाँ पे बाय है, बाय BUY बाय करके आता है, उसमें आपको सिल्वर करना है, सिल्वर। उसमें रेंटल ऑप्शन आता है, वो रेंटल ऑप्शन करेंगे ना, 1 महीने का 708 रुपया होता है। वो जो इसमें आपको बेसिक डिटेल आपको मैंने पीपीटी भेज दिया है, इसमें सीरियल नंबर और वो लगेगा, फिर आपको टैली उसमें डाउनलोड भी होता है। टैली में जो सॉल्यूशन में जाएंगे ना, वहाँ डाउनलोड का एक और मेंशन होता है, तो वर्जन है ना, वो वर्जन डाउनलोड करने का, तो टैली ओपन होगा, फिर ये लाइसेंस नंबर डालेंगे ना, ऑटोमेटिक लाइसेंस नंबर, ये लाइसेंस नंबर डालेंगे तो एक्टिवेट हो जाएगा महीने के लिए। तो इसमें नंबर आता है, ये लाइसेंस नंबर और उसका पासवर्ड, तो दोनों इनवॉइस में आ ही जाएगा ईमेल में, तो वो डालेंगे ना तो टैली चालू हो जाएगा।
हेलो,
आपके पास इंटरनेट नहीं होगा ना?
सर आपकी आवाज आ रही है सर?
नहीं, लेकिन टैली आपको तो वहाँ पे आपके कंप्यूटर पे इंटरनेट चाहिए, लैपटॉप पे इंस्टॉल होगा तो लैपटॉप पे आप काम नहीं कर पाएंगे।
मिश्रा जी आपका माइक म्यूट कीजिए प्लीज।
हाँ
म्यूट है सर, मेरा माइक म्यूट है।
किधर से
क्या
मेरा पास बैकअप देखो फरवरी का भी है, लेकिन मैं आपको दिसंबर का बैकअप दूंगा। अमृता, क्योंकि मैंने बहुत सारी एंट्री क्वार्टर में डाली थी। आपको लगता है पूरी डालने की जगह पे आपको दिसंबर का तो आपको जनवरी फरवरी में दोनों डेटा देता हूँ। आप वो एंट्री सीधा कॉपी पेस्ट मार दो। आपको बैंक का एंट्री रहेगा ना,
हेलो।
बाकी तो कोई एंट्री है नहीं अपने पास।
सर ये लैपटॉप पे मैं आ गया हूँ, सामने ये है, लेकिन मेरा तो दिख नहीं रहा है। आ तो रहा है टॉकिंग बालकिशन अग्रवाल।
हाँ तो
दिख
एक
रहा है
जो होगा
मेरे
ना, कितना होगा
स्क्रीन पे?
हाँ
निशा जी वहां से म्यूट ऑन कर दीजिए।
कौन है
हाँ,
हाँ
का वो है बालकृष्ण, हाँ हाँ
हाँ
okay. Sorry, I really apologize to all the members.
हेलो। यस मुर्तुजा सर, आर यू हियरिंग मी?
Yeah, can you please put yourself on mute, please?
ओके।
Yeah. Okay. Extremely sorry for all the confusion, and let me now proceed ahead to the introduction of the first speaker. Padma Shri is a partner with audit and assurance practice at MSKB and Associate LLP. She operates out of Mumbai office and has over 16 years of extensive experience in practicing audit services across industry verticals of insurance, financial services, and manufacturing. He is in charge of keeping the audit team well informed of the latest technical developments in various statutes and regulations, preparation of certain publications for internal as well as external use. She also does the standardization of various reports, templates, work paper for the purposes of audit. She is also responsible for the quality assurance function in the audit and assurance services, which technical includes review of deliverable, conduct of online reviews, cold review of audit files, and thereby managing firm risk. She possesses in-depth knowledge of standards of auditing, both Indian and international, quality standards, methodology, IFRS, company law, accounting standards, Ind AS, IPO related matters, and other statutes. Also possesses expert knowledge of audit tools. She imparts training programs on technical, quality, methodology, APT, and other matters of professional interest. And she is also a contributor to WRC publication, anthology on CAM and other reporting matters. With that, let me once again welcome Padma Shri. Padma Shri, over to you. You can take over.
Hello everyone, good afternoon. Thank you Mr. Murtuza and thank you Mr. Vishal. Thanks for a lovely introduction, and also special thanks to Mr. Vishal because I first time started working with the WRC Corporate Allied Laws Committee, and I understood the way we have to work and the things that we have to do. But he was a great guiding person, and with the help of him, we did contribute, and then we could achieve whatever we could. So starting off with today's topic, the first thing, most important that we will look at during the course of our audit, because majority of the audits that we do are corporate audits, and many audits in terms of Companies Act applicability audits. So we thought of covering important updates in the Companies Act 2013 during the financial year 2019-20. Before we start off, I would like to mention that there were a lot of updates. Obviously, we have kind of have picked and chosen a few of the updates which are of higher importance, which you have to keep in mind during the course of audit as well as otherwise in your practice. More of a procedural formalities of some tweakings in the form, some changes in those areas we have not much touched upon, though the most important ones among those also picked up. So starting accordingly the session. So first amendment that relates to in the MCA arena is the first one that is there is Ind AS amendment. There was introduction of this Ind AS 116, which replaced Ind AS 17. So I the Ind AS 116 itself is a huge topic. There can be 5 to 6 hours session on Ind AS 116 on how to recognize leases and what are the transition provisions in that. And then there are some tools available also in the market to assess what is the impact on each of these companies and things like that. Because there is a shift in the thinking and there is a shift in the change in terms of how Ind AS, hello? Yeah, how Ind AS 116 leases standard will operate. This was introduced on 30th March 2019 and made applicable from this financial year. So, with respect to the transition provisions, with respect to certain things that we have to consider in terms of the business combinations and in terms of the financial instruments, that is how to value the financial liabilities or the corresponding financial assets arising out of the leasing transactions. And also in case of joint arrangements, how do we value and how do we record the leases? There were consequent account of transactions and on account of certain transitions, how did they work? So those are the things that are changed as a consequential amendment in terms of introduction of Ind AS 116. Then there were certain changes that were necessary in Ind AS 119 in Ind AS 19 also on account of employee benefits. So certain changes that are going to happen as a result of 116, those are also amended. Also, if there was any borrowing cost which was associated with this on account of Ind AS 116, which has undergone certain changes, that is if it is a qualified asset, how the borrowing cost has to be recognized. So those consequential changes was also made, and accordingly a change in investment in associate and joint venture, which is Ind AS 28 as well. So Ind AS 116 is now applicable from this year, and this is the first year. So there is a transition effect that you will have to give. There will be elaborate notes of transition effect that you have to give, and additional disclosures that are necessary, which has to be given in the financial statements. Coming to other amendments, we have, sorry. Yeah. ADT 1, actually, there was a circular. Okay. Okay. So there was a circular on May 13, 2019, which actually stated that ADT 1 that was filed through GNL2. So as we all are aware, the ADT 1 earlier was not available online, and then there were certain appointment formalities that many of the companies had filed through GNL2, because at that point in time we did not have ADT 1, and then there was a circular removal of difficulty order rather, which was given, which said that if there are any forms that cannot be uploaded directly, then GNL2 can be used, and then that can
हेलो
be uploaded
हेलो
through
हेलो
GNL2.
हेलो
Hello?
वैसे मैडम आपके बाजू में पंखा या एसी चालू है कुछ मैडम?
Nahi?
एसी या पंखा पूरा आवाज आ रहा है मैम.
Hello?
एसी या फैन का
Hello?
आवाज आ रहा है मैडम आपके यहाँ से बाजू में. ब्रो एसी या फैन का आवाज आ रहा है आपके यहाँ से.
Okay.
हाँ कंटिन्यू करिए दूसरा देखिए.
Just 1 second, मैं fan बंद कर देती हूँ. I'm sorry. Give me a second. Is that okay now?
Okay, ma'am. Okay.
Sorry. Is there any other noise that you are facing?
Ma'am, continue.
Should I continue?
Yeah, please. Your voice is clear, madam. Please.
Okay, sorry for the trouble. So we were talking about GNL2. So GNL2 was the form that we used to use, and then we used to file all the appointment formalities since ADT1 was not available. So there was a circular on May 13, 2019, which told us that filed during the period from April 1, 2014 to October 20, 2014. If we had filed any, if the companies had filed any form during this period using GNL2, they may e-file Form 1DT for Form ADT1 for appointment of auditor for the period March 2019 without fee till June 2019. So if at all there were any such cases, then that had to be refiled, and that was the period that was open at that point in time. The next amendment is with respect to significant beneficial owners, the second amendment. So as we know that in case of a beneficiary, that's if say for example, if you have a foreign company, and then if you're the whole, if Indian company is a wholly owned subsidiary, then obviously there cannot be there cannot be only one shareholder in the company. There has to be two shareholders, and accordingly, if for the other shareholder who is a nominee shareholder, he needs to file the beneficial ownership form with the MCA. So there was an amendment in this in which it said that the declaration in section 90 has to be notified through this form, and it is very essential because this is very important from the audit angle, because there are many exemptions or many disclosure requirements that are not applicable to a wholly owned subsidiary, or certain transactions are also exempt in certain cases where the transaction is between the wholly owned subsidiary and the holding company. If this beneficial form is not filed, then what happens is that it doesn't become a wholly owned subsidiary. So there are those exemptions, and the things that we are talking about may not exist. So actually, so that is the importance of this form. We have seen cases, in the sense we have come across queries or questions or cases wherein this beneficiary form has not been filed, and thereby it loses the status of this for wholly owned subsidiary. The next amendment is with respect to acceptance of deposit rules. So as per this notification, there was a return of deposit outstanding receipt of money or loan by a company that is not considered as deposits that was necessary to be filed. So this specific notification actually brought out a lot of confusion. Basically, it was seen as everyone has to file it, whether you have a deposit or you don't have a deposit. So initially, every company was supposed to file it. It was the understanding. There was a lot of chaos around it. There was a lot of understanding, interpretation issues around it. And then a clarification also came in terms of those who are having certain deposits or who are classifying it as certain deposits based on the disclosure norms of Section 73 and the consequentially rules. They only are supposed to file this form, and accordingly, and that too within 90 days from 31st March 2019. So now as 31st March 2019 was over, and then this was supposed to be done by June 19, there was a lot of confusion with respect to it, which later on got clarified that only certain types of companies need to be filing who have deposits. Those who do not have deposits need not file this form. There was a amendment with respect to CSR. MCA had amended Schedule 7 of CSR. This has included in May 2019 itself. This has included all kinds of activity, which actually any kind of contribution to activities relating to disaster management, including relief, rehabilitation, and reconstruction activities. So certain of the expenditure that are being spent for COVID-19 and things like that, and to cover up the disaster management during this event, that is also that can also get covered here. Other kinds of disaster management, like last time there were floods in few of the states and things like that, so contribution towards those things also get covered here specifically. There was another notification on October 11, 2019, which included one more activity under the CSR domain. That was contribution of funds that were provided to technology incubators located within the academic institutions which are approved by the central government. So there was a category of these institutions that was approved by the central government, and if you make a contribution to them, then that was actually considered as a CSR expenditure. Then there was an amendment with respect to meetings of board and its powers. This amendment basically has amended the rule 15 of sub rule 3 with respect to threshold for a company which it can enter into related party transactions, and it had come into effect from November 18, 2019. So the thresholds that were laid down earlier were revised, and now the board's power, how it will amend or approve it as a blanket transaction or a single transaction, individual transaction, all those things were notified here. Now it will be interesting to note that there are different mechanisms that exist under section 188 of the Companies Act as well as SEBI LODR. So in case of a listed company, the approval mechanism is slightly different, and still there is a difference between how a related party transaction is to be approved in case of a listed company and how it has to be in case of a non-listed company. The next amendment was with respect to filing of cost audit report. For the financial year 2018-19, because during the year there were lots of reports that got revised or introduced or in a phased manner. So this was one of the forms which was under revision, and it has got included. So as per the circular dated 30th December 2019, the cost audit report without payment of additional fee, the date was extended till February 20, 2020. There's no further extension after all these events, because the date itself was February 20, and in India the COVID impact started from mid of March, so there was no extension for this. So the cost audit report had to be filed by February 20. There was another circular with respect to time limit for filing of the cost records that has to be maintained by the company and the cost audit report, and that was extended up to 31st March 2019 without payment of additional fees. Now these are minor amendments, but then what happens is why I have tried to put it over here is these are the things that will be useful in terms of CARO reporting, and also in terms of minor reportings and statutory obligations that we have to check under the Companies Act. So when we report under section 143(3) of the Companies Act in the legal and regulatory matter of the audit report, it is not restricted to only the matters that are asked there. If there are significant non-compliances, a view does exist that we can always report it there if there is any major non-compliance of the sections of the Companies Act. Then there was this was a major drive that was done by Government of India with respect to striking off and winding up of certain companies and the cleaning up of the entire MCA data. So there was an amendment to that rule wherein Form STK for removing the name from the register of companies in case of a winding up. The fees had been increased from 5,000 to 10,000. Also, there was a new Form STK 8 that has to be filled in at that point in time. There was one more amendment with respect to MSME. So all the companies, all the specified companies had to file MSME Form 1 with a detail of all the outstanding dues to micro, small enterprises, suppliers existing on that date. So the order came on January 22nd, 2019, and then from that point in time, within 30 days, you had to whatever is the 30 days within that time, you had to file a return. So this return is necessary biannually. So you have to file a return from April to September. The due date is 31st October, and from October to March, the due date is 30th of April. So this also becomes a necessary return for us to look at during the time of audit, because we have to do a three-way match here, in the sense whether the company has identified the MSME parties, whether they have necessary disclosures, that is the outstanding amount, the interest due, and the other things that are necessary to be disclosed there. And we can also match it with this return that they have to file on a biannual basis. Then coming to appointment and qualification of directors, so the companies that are governed by Rule 25A, if they fail to file the E-form of active within the specified period, the DIN allotted to these directors would be marked as active non-compliant company. So this was a specific category of directors. So this is not disqualified directors. However, they will be marked as active non-compliant company directors. So this was a separate category that was culled out. Then we all are aware about NFRA rules. From the time Companies Act got framed, there was a provision to actually build up a body which was a NFRA, and then the NFRA rules specifically came into existence, and then the NFRA as a body, hello. NFRA as a body was formed. There is a specific website of nfra.gov.in, and the rules actually laid down for the forming up of the body, and then which are the types of companies that will get covered there, which are the types of review mechanisms that they can have, that is the audit quality review, AQR what they call, who will do the review, how the reviews will be done, what will be the outcome of the review. And then also there were two forms that were released under, and the disciplinary proceedings and the mechanism as well. There were two forms that were published under NFRA regime. One was NFRA 1, which was to be filled up by the companies. So the companies that are covered under NFRA, the companies that were covered under the NFRA definition and the other companies. So this NFRA 1 has to be filed up by the companies, and NFRA 2 is to be filled in by all the audit firms. So any firm that is actually doing audit of any of the types of companies that are covered under the NFRA rules, we had to file a form. So in this form, actually, I think many firms must have tried to fill in, and then we also, each of the firm is facing its own difficulties. I think I have spoken to at least 6 to 7 firms, and we all have certain queries which are unresolved. So the date was extended, and then it was re-extended. Initially, the return was to be filed by June, and then it got extended to November, because every year by November you have to fill in the form. And then initially the date was February, which actually went to March, and then now the final date is ultimately May 5th is the final date after the extension that has come into effect. So this NFRA 2 has to be filled in. There are elaborate details containing client particulars, details of who is signing their audit report, and their membership number and everything. So that has to be filled in, and the closure has to be done by May 5th. Then there was another rule in terms of share capital and debentures amendment rules. So this actually amendment was specifically with respect to equity shares with differential rights. What are the things that are to be taken care of in terms of issue of equity share capital with differential rights, and also in case of certificate of shares which are not in demat format. Because I think hello.
No, I'm at work yet. Hello.
Hello.
working from home, can't go to office.
Yes, ma'am.
Hello. We are all working.
Someone is on unmute.
And that's the way it is. I mean,
Sir, please unmute your mic.
आप सब अपना माइक म्यूट करिए.
yeah, it is.
Everybody has to mute
That's
their
all.
mic.
That's all. Agree. But considering the bloody all that they're doing on Facebook. Yeah. Even if they are suppressed, how much would they be suppressed? Even if you increase the 100%, we still go.
Okay, so
Yes, ma'am. Yes, ma'am. Okay, बोलिए.
yeah, am I audible?
Yes, ma'am. Yes, ma'am.
Yeah. So yeah, so the demat form of shares, years ago there was a notification wherein all the shares were to be converted into a demat. So this is an amendment to that, which says that in case if certain shares are not in demat format, how that is to be taken care of and what is to be done further with respect to that. And then there were certain amendments with respect to debentures, that is creation of debenture redemption reserve as well. So certain type of companies are not required to create debenture redemption reserve anymore. And it also issued a clarification with respect to section 232(6). So this is basically with respect to the anomaly that existed in terms of in terms of AS 14, wherein there was an appointed date and then acquisition date and things like that. So in this, it clarifies the term here appointed date, which is deemed to be acquisition date for the purpose of accounting of Ind AS 103 in terms of business combinations. So there was always a difference between three dates: appointed date, effective date, and then the actual acquisition date. So it clarified that the appointed date is the acquisition date, and then we still have an effective date, which is actually when the court order is, when the NCLT order is released, and then we file it with the ROC. Then we come to the important section on COVID-19 impact. So there were certain relaxations that were provided by the ministries and across board by various today also we by the various organized government bodies. So today also we had a detailed relief package or certain things that were provided by the RBI governor. So in terms of MCA, what are the relaxations that were provided? So filing of any documents, returns or statements on MCA 21, so from the period 1st April to 30th September 2020, if it is pertaining to the period 1st April to 2020 to 30th April 2020, then there is no additional fees that is chargeable. Incorporation of a company, declaration of commencement of business within 6 months of incorporation, so that had to be given. Now an extension of further 6 months is provided. So with respect to the declaration of commencement of business, an extension of 6 months is available now. We all are aware that the mandatory board meeting requirement has been relaxed. So the intervals between the meetings, which was 120 days, is extended by a period of 60 days for the next 2 quarters. So that exists till 30th September. So the frequency of the meetings is can now be relaxed, and instead of 120 days, it is an extension of 60 days, and this will exist till 30th of September. This is to avoid, and then this is to actually take care of all the things that of the health and hygiene and everyone adhering to the rules of the government. Then meeting to be conducted by independent directors. in case if the company is unable to hold a meeting of the independent directors, it will not be viewed as a violation. This is important from the point of view of the audit, because we always see that in case of independent directors are not able to hold a meeting, we used to take it as a means as not as a good sign or as a risk, and it is also a violation. So it used to be a risk of material misstatement maybe, or a risk that we identify during the period of audit for further evaluation as to how this risk is mitigated. So it used to be an audit risk always, and also a violation. So this will not be seen as violation. However, for the purpose of audit, we would still insist as to looking at various circumstances, and also what is the alternate procedure or the alternate that has been done that everyone is satisfied. Then the CARO, so we all are aware that the CARO 2020 was issued. However, the applicability of the CARO is now from 2020-21. Institute is also, I think, working on the issue of the guidance note on CARO. Obviously, when the CARO order gets, when the guidance note is out, and we all are aware about, we all will become aware about the reporting nuances and how to be reporting certain things, because there are certain complex clauses on quarterly report, quarterly financial and fund flow tally of even private companies and things like that, which actually there were queries, questions from all clients, wherein they were asking as to how do we cater to it. We never prepared any half yearly, quarterly financial statements, also the borrowing tally and things like that. So I think we have time now, and then we can also see how the reporting has to be done here. The next thing is relating to minimum residency of a director in India. So the minimum number of days the director had to reside in India, and then there was a requirement that one director has to be resident in India. Now, during the said circumstances, in case someone is not able to be a resident director, it will not be seen as a violation in this period. So these are specifics. So the slide starting from here as a COVID impact, these are specifics, and these are limited only to this period. Any extension to these relaxations will also be limited to that period, and it will not be applicable for any other financial year, or the past financial year, or future financial year, because sometimes we do end up auditing more than one financial year's audit. So this may not be applicable for the past and the future, but this will be only for the period affected, which is the current period. Then there is a relaxation in terms of, so section 73, the section relating to deposits, says that if you have issued a public deposit, then by the end of the 30th of April, you need to maintain liquidity amounting to 20% of deposits that are maturing the next year. So accordingly, say if you have 1,000 rupees as a deposit that is supposed to be maturing on 2020-21, you are supposed to keep aside an amount of 20%, which is 200, by 30th April 2020 itself, with respect to so that is the liquid deposit out of liquidity amount maintained with respect to the repayment of deposits and the interest thereon. So that date wherein you had to keep aside that amount of 30th April 2020, that date is extended to 30th June 2020 now in the current circumstance. Also, in terms of share capital and debenture related sections, we had to invest or deposit at least 15% of the debentures that were maturing in the specified methods of investments or deposits before 30th of April 2020. Now that extension has gone up to 30th of June 2020. These are smaller things, but we always look at these things as compliances, non-compliances also, because in Schedule 3 we have to give various types of defaults, and in CARO we have to give all statutory compliances also. So these smaller things will come into picture, and we have to take care of all these things because we need to be compliant with all these things. So these are one-time exceptions which we have to note in our working papers, and then make note of it appropriately, so that we distinguish between the violations and non-violations this time. There was a form on 23rd March 2020 that was launched, wherein every designated partner of an LLP as well as one director of the company had to fill in the simple web form with minimum fields, which can be actually filed in from anywhere. You had to just log in and then fill in those few details. That is with respect to the readiness of affirmation of readiness towards COVID-19. So it had very basic questions that are you equipped to face this, what are the things that you are doing. So it was basic 5 to 6 questions only, and then this had to be filled in by one of the directors or the designated partner in case of LLP. Also, to file this form there was no requirement of DSE, and it doesn't ask for any fees. So it was a very simple fees which had to be, and it was to be filled in at the earliest convenience. CSR contributions, spending of CSR funds for COVID-19 is now eligible for CSR activity. So one thing that had happened in May itself was disaster management, and second thing that has been specifically included now in the current situation is if at all anyone is contributing to the PM CARES fund, or if they are specifically aiding or helping anything in terms of COVID-19, then that is a CSR contribution. So anything that is spent towards healthcare, including preventive healthcare, sanitation, disaster management, all these things specifically for COVID-19 will be a CSR expenditure. This was another important amendment which came actually just very recently, I think 1.5 weeks ago. It is with respect to passing of ordinary resolution and special resolution by Companies Act. So here the basis is that government is telling us, government is actually telling us to maintain the policies of the central government, that is the social distancing or not meeting, and then facilitating business during the lockdown period also. So this circular basically says that companies are requested to take all the decisions of urgent nature requiring approval of members other than items of ordinary business where a person has a right to be heard through the mechanism of postal ballot or voting in accordance with Companies Act and rules they made thereunder without holding any general meeting. So conduct the meetings without the physical presence of the members, the same way that we are conducting our seminars without the physical presence. So we all are connected, we all are there, we all are are getting updated every day. So that's a great initiative by CI, WRC, everyone. So similarly they can conduct business, they can conduct the meetings, but without the physical presence. Further, they say that the following procedure is required to be adopted for conducted a meeting if anything is very urgent. In case any EGM is not avoidable, so if there has to be an EGM, so there are certain matters that can only be taken decision to in an EGM. So avoid the EGM is first thing that they are saying. If you cannot avoid the EGM before 30th June 2020, then follow this procedure. So hold the EGM through video conferencing or other audio visual method. Facility for appointment of a proxy is not available because it's a web link and then you yourself can join. There's no point of appointing a proxy for it. At least one independent director, so for companies where independent director is applicable, should attend the meeting through VC or audio video method. Auditor or his authorized representative who is qualified to be the auditor shall attend such meeting through VC or OAVM. Notice has to be served before the date of circular, that is 8th April 2020. May adopt above framework by obtaining consent of member in accordance with section 10 and issuing fresh notice of shorter duration. So in case if someone has already issued a notice before 8th of April, then this procedure can still be adopted by following the methodology and by following the steps that have been given here and issuing a fresh shorter notice of duration with all the disclosures and all the procedures that are necessary. All resolutions that are passed in accordance with this mechanism have to be filed with ROC within 60 days of the said meeting. So that is another thing. So instead of 30 days, it's 60 days. So any meeting that is held in this mode has to be filed with the ROC within 60 days. So I think this is one of the important amendment, because there were queries around how do we conduct business. So conducting business working from home is one thing, but there are certain decisions or certain things that can be done in a meeting. So if at all you want to hold meeting, then these are the things that are available as a legal procedure as to how you can hold a meeting. Apart from that, MCA has also introduced companies fresh start scheme and LLP settlement scheme. So these schemes are to incentivize the compliance and reduce compliance burden during this period. So this is for the period starting from 1st April 2020 and ending on 30th September 2020. So anything that has to be done can be done through this mode, and then it is a easier compliance. There was a detailed FAQ with related to CSR on COVID-19 specifically was also released. So basically, the FAQ covers main things like what is the contribution towards, and what are the things that are allowable. It is whether preventive healthcare is available, whether sanitization expenses are available, so on and so forth. So the detailed FAQ is provided, and CSR activities, it gets covered under CSR activities. So this was the update on the Companies Act, the major updates during the period. So the first session, I think, gets concluded here largely. So are there any questions relating to this?
Yeah. मिश्रा जी क्वेश्चंस आप शेयर कर दीजिए.
We request all the participants to type their questions in the chat box relating to this session. The speaker will try to take the session on this subject now, all the questions, and then we can proceed to the next one, which is SA701. Here we are.
Padmashri, the questions
Anyway,
are there on the screen.
yeah, I can see that. Anyway, for companies whose name have been stuck off other than NCLT. If the names have been stuck off by NCLT, there is another procedure that is elaborated there, and you will have to approach the appellate tribunal, is what I understand there. If a director has two DIN numbers, one active and other inactive, what is to be done? So this is a typical procedural thing. So ideally, if he has to have one DIN number, and if he has two DIN number, I think a query can be raised on MCA, and then it can be sorted. Because if he is an active non-compliant director in terms of if he is termed as active non-compliant director once, it applies to him whether he has another DIN number or otherwise. If the shareholders of Indian entity are 100% foreign entities, then do we need to disclose their beneficial interest? If the shareholders of Indian entity are 100% foreign entities, that means both the entities are foreign. If that is the case, so we were talking about someone holding a beneficial interest. So what happens is, if the company has 100 shares, 99 shares are held by the company, and one share is held by a single person who actually represents the 99 shareholder, and he says that I am holding this for beneficial interest of someone. So that is the case we were talking about. If all the shares are completely held 100%, I don't think so that can be a complete case. But then if they are being held by two foreign parties, there's no beneficial interest there. Do we have to file form DIR 3 through web service every year? If yes, what will be the due date? DIR 3, I think yes, you have to file it. Due date, I will have to check and get back. I don't offhand remember that, to be honest. What is new amended threshold limit For what? I didn't understand question number 5. Whether due date of 30th April is extended for MSME return form 1 during lockdown. No, there was no notification with respect to this. I had not seen any notification in terms of this. Can you please shed light on obligations of a company if its first financial year is 2020-21? So all the provisions that are otherwise applicable to the Companies Act to the companies will be applicable. If there are any specific exemptions that are available to others, that will be available. And I think if you are talking in terms of preparing the financial statements on 31st March, there is no specific relaxation with respect to that, that if you are formed, if you are a company formed during the year 2020-21, then you can or you cannot, or your financial statement year automatically gets extended. There is no such this thing over there. There is no such leeway over there. So it will be business as usual. If there are any specific queries, or if there are it relates to any specific of these situations, then accordingly the similar things will be handled. CAR was optional, right? What is CAR? I did not understand question number 8. Car was optional. Cost audit report. If we are talking about cost audit report, if you're talking about cost audit report, it was for company, or if companies are supposed to get the if companies are supposed to get the cost audit done, then the filing of cost audit report was obligatory. Initially it was optional, but then later on it got made mandatory, is what I understand. Whether readiness form is compulsory to be filed? Yes. So that question is twice there. Even delay payments during lockdown period should be counted for MSME. As far as the act is concerned, and as far as we understand the act in MSME, there is no relaxation on you can pay it beyond the stipulated time of time that is mentioned in the MSME Act. So the delay payments will have to be counted. At present understanding the act is what is the interpretation. Is it mandatory to convert physical shares in demat for private companies? With respect to private companies, there's nothing specific that is stated here. It was with respect to companies which are public and which are in the process of IPO. Still, I will once again check and I can get back on this question. Whether any company has not filed annual return for 18-19, can delay fees is exempted as per this circular. So basically it specifically said that any filings that are to be done between 1st April to 30th September. So as far as we understand, it is not for all the delays that we had earlier also, that we can use this period and then we can do all the filings in this period. How I understand is that between this period, whatever falls due, and then if there is any delay, so say for example there was a return that was to be filed in 30th April. A few minutes ago someone else asked that question. So though there is no relaxation there, but then instead of 30th April, if it is filed later on, I don't think so that becomes a delay, that attracts a delay fees, is what I understand. I think I was at question number 14. So can you please scroll up? Hello? Can we just scroll up, because I think I was at question number 12 or 14.
Mishra ji.
Yeah, thank you. If director is disqualified under section 164, then can annual return be filed for earlier years in this extension? So the same thing applies here also. Certain procedural things which existed earlier, or there were defaults that earlier existed, or if there were delays that were there earlier, so this period of no additional fees is not to make good those things, but is what I understand is that during this period, whatever is supposed to be done, if it is not done, then an extension for this. However, procedurally, if it is allowing you to file, you can use the opportunity. Whether notices issued by MCA for default of late submission of balance sheet and annual returns for prosecution, same is covered under settlement scheme. Not very sure of it. I don't think so. It is not for notices that are already issued by MCA for delay filing, but it is for other cases. It's I don't think so. Status of LLP is currently defunct position. If I ignore it, will disqualify the DN for 5 years. When stuck off, or better take advantage of scheme and revive it and then apply for closure. I think it's always better to apply, take advantage of the scheme in this case, because you don't want to get the DIN disqualified for 5 years. So in this case, depending on the case and what is the type of what is the reason stated for the defunct thing, you have to evaluate, and then we can finalize the position as to whether it has to be taken advantage of. But given the position, given the question and given the position, I think taking advantage of the scheme is always better. Caro provisions applicable from 2021. Can you explain Caro provisions? So Caro provisions, there are a few more clauses that are introduced in Caro. Few of the clauses that I gave examples as the fund flow, the quarterly the quarterly borrowing, and the tally of the things. Then there are procedural things also that are to be done. Uh, because there are things that are under how to report, what to report, and things like that that are under due discussion. uh, I think they are elaborate, that would require an elaborate session in itself, is what I understand. Few of the things that were apart from what we had earlier is I gave examples of. Detailed study and a detailed session on itself will be warranted, and I'm sure obviously our esteemed office bearers are going to have conduct a appoint a speaker and conduct a session on it. Though we are also studying it, once the guidance note is out, uh, we will be happy to discuss it more further. One company whose case is pending with NCLT but no orders passed by NCLT. Whether the company can file their pending compliances under company's Fresh Start Scheme 2020. There is no provision of these kind of cases under the Fresh Start Scheme, is what I understand. It gives under certain defunct and other things that are there. It is not about if a case is pending under NCLT, you can shift it, because even if you want to shift it in that case, you will need a documentary evidence that the case is not being taken up, or it is the case is closed on the basis of an earlier judgment or something, and then you need to go about it. So that is not a way given for switching between these two things. What if the company has not opened bank account and not applied commencement certificate? They have to pay fine? So if they have not opened a bank account, and if they have not at all, so there was an extension of 6 months for commencement of business declaration. So if it falls under that case, then you can take that 6 months, and then there is no fine that is required here. But if that is beyond that period, or if it is the notification if the case pertains to the period before that notification, then it will attract fine. Are the due dates of all compliances related to LLP extended due to COVID-19? As of now, whatever is given as a notification, I've tried to cover those. I don't think so there is any blanket extension of all the dates. It's not a blanket extension of all the dates. So specific extensions are given for specific sections and specific things. It's not a complete thing that is given that you can do everything and everything is actually extended. So we will have to wait and watch for LLP extensions, because those are anyways after April and May. So the notification issued on 23rd March regarding reporting by one director, and the last date is 31st March. But due to lockdown situation, then late fees be levied. So this is again a situation that has arisen because of the lockdown. So I don't think so this will attract late fees or penalty. So this can be got done under that period, the no filing fees period that was there in the notification. If we file annual return now for financial year 18-19, whether while uploading form we have to pay additional charge and fees. This I think we have already covered in detail as to it is not for the delays that were existing earlier than this situation. So this situation is for pertaining to this period specifically. Company was registered in May 2019 and have to INC 28 till October 2019, but filed in February 20. Can it take shelter of 6 months delayed period for avoiding late fees to be imposed on directors and company itself? So if the set date, so in your case, if the set date falls before that 6 months notification date, then it can take shelter of. If it falls beyond that, then it cannot take shelter of. That's the basic differences. LLP Form 11 filing due date for 1920 31st May. If lockdown continues, whether this due date will be extended. Now, what will be extended, we don't have an idea. What is already done is the summary that we have presented. And as I said, there is no blanket extension as of now. There are specific extensions that are provided, and we have to actually keep a watch on what all the things that are available and how the things are progressing. And then maybe turn by turn, we need to look into what all are the things that we need exemptions for. And what all are the things that will be keeping evolving, and what all more extensions we are getting. STK2. Yeah, if it is any kinds of forms. So the notification says any form that you were to file between this period, which falls due in this period, and you could not file, or if there is any delay in filing. So everything can be done later. So STK2 also gets covered there. If it is a resubmission as well, any due date that is falling between that time, you should be able to do it later. Are we done? Any other questions?
No, ma'am.
विशाल जी स्क्रीन वापस मैम को दे दीजिए, उनका सेकंड प्रेजेंटेशन चालू करने के लिए.
Ma'am.
Yeah, hi. Can you see the screen with SA701?
Yes, ma'am.
Yes, we can.
Yeah, thank you. Thanks for the questions, and we continue on SA701. I think those questions gave an insight also on some of the practical difficulties that we all are facing, and few of the questions obviously we will have to think more because it's case specific and you know the case better. So let's start off with the next session, which is SA701. So communicating key audit matters in the independent audit report. So this is the layout of the session or the discussion, I would say. So the definition of the KAM, a step-by-step approach to determining how do we determine the KAM, the factors that we have to consider at each stage of the process, and we will also share a little bit of examples of typical KAMs and some of the KAM considerations as to how it is affecting other things. So before we start off, a brief background of the KAM. KAMs actually started 3 to 4 years ago in UK and other countries. So what is it? What is the KAM basically? KAM is, in other words, key audit matters. That means there are matters which we discuss, which we finalize, and which we take judgments or estimates or final calls based on certain assumptions and detailed audit evidence verifications. But they are matters of importance, which we also discuss with those charged with governance. However, these are not matters that we have to necessarily uh, report as a EOM or a qualification as such, because they do not fit into the standard of 705, 706, and they do not warrant a complete warrant a EOM or qualification, because they are not non-compliances. So these are not matters that are non-compliances, or these are not matters that are essential, departure from the standard or something, because they would anyways fit into the definition of qualification or the EOM, and they would be definitely be stated in the report like that. So KAM, when we begin with, we have to understand that KAM is not a substitute of qualification. KAM is not a substitute of EOM. So if it is a matter of qualification, it has to be a qualification and it is not a KAM. However, rare circumstances, KAM and EOM can coexist. On a same matter, it can be a KAM and it can be a EOM. In rare circumstances, it can exist, but it is definitely not a substitute to qualification. We have picked up a few paras of the standard itself, so that we understand what's the KAM. KAM is basically those matters that in the auditor's professional judgment. So how do we get professional judgment? We all have professional judgment over a period of time, and dealing with various scenarios, and discussing interacting with various things, we gain the professional judgment over a period of time. It comes by experience, and many of us have gained it by dealing with different situations were of most significance in the audit of financial statements of the current period. So this is something, the matter that is very significant, and it relates to the current period. Key audit matters are selected from matters communicated with those charged with governance. So basically, let's take a very simple example. We do our audit, we have a query list. So we have 25 queries, out of which say 15 get resolved by junior team members themselves. 4 more queries get resolved by a senior in charge or the audit in charge, and then ultimately there are 3 to 4 matters that actually come to our table as directors or partners, and then which we discuss in detail with the CFO, CEO of the company, and also we take it to the those charged with governance, that means audit committee or the board, or as the case may be. So KAM is a matter that is actually comes from what we discuss from those charged with governance. So this is matter of significance, this is matter of importance, and this comes from the matter that actually is listed down, and it is given to those charged with governance. The effective date of SA 701 was 1/4/2018. What are the requirements for communicating the KAM? This requirement stems with the intention to enhance the value of the auditor's report to users by providing greater transparency about the audit that has been performed. So it used to be always a gray matter as to there are certain issues that we actually discuss, we actually end up taking additional evidences. We accept certain management judgments, assessments based on our professional judgment and the audit evidence that we have seen, and then we have concluded on certain matters. Now these are matters of such significance that it will, if it is presented in the auditor's report, it gives more transparency, it is better to present it, and it is more efficient to for the users of financial statements to understand the audit report itself. And the factors that have led to the creation of 701 also included it was establishing a focus on how KAM affected the auditor's approach to audit, particularly those matters that kept the auditor awake at night. So this means that there were some matters which we were as auditors thinking twice, thrice, four times, discussing with various people, discussing with our peers, following the consultation policy also within the firms, consulting with the technical people, consulting with other partners, so on and so forth. So these were matters which, if presented in the auditor report, would always be better, transparent, and will add value to the financial statements users. Providing for increased focus by management and those charged with governance on the understanding of their entity, the related disclosures, and those areas that have significant management judgment attached to them. So KM is also the matter that actually which requires significant management judgment, which is where is involved, and where we do additional audit procedures as well. Encouraging greater engagement between intended users of the financial statements, management, and TCWG. So there is always a two-way communication. So we communicate with the users of the financial statement, management, and also with the TCWG. Certain paras of SA 701, as I pointed out earlier, which are necessary and which we should understand, because if without understanding this, actually we will not be able to conclude what a KAM is and how to write a KAM. So para 11 of S 701 specifically tells us auditor shall describe each key audit matter using a appropriate subheading. So basically we will first write key audit matter, and then we will write subheading. Subheading will be, say for example, impairment of assets in a separate section of the auditor's report. So there is a placement that is already given, so you will have it at the specific place in the auditor's report, unless the circumstance in para 14 and 15 apply. So para 14 and 15 we will see later. So the introductory language in this section of the auditor's report should state, so basically we'll have a heading key audit matter, and then we will say key audit matters are those matters that in the auditor's professional judgment were of the most significance in the audit of financial statements of financial year 1920, and these matters were addressed in the context of the audit of the financial statements as a whole and informing the auditor's opinion thereon, and the auditors do not provide a separate opinion on these matters. So this is a standard language that we will have to use and we will have to write in our report. All the standard report formats, I guess, already have this incorporated. So it is like ICFR opinion that we gave last year, IFC opinion in short that we gave last year. So that was the first time when we saw from last 4 years, what I mean to say. So that was the first time when we saw in a report that in IFC report we are explaining what is an IFC, what is a material weakness, how do we conclude, what are the inherent limitations. So everything was in detail. So this is like this, that same KAM first we are defining, we're making the people understand that this is a KAM and this is the explanation of the KAM, and then the KAM, then the matter. Para 13 states that the description of each key audit matter in the key audit matter section of the auditor's report shall include a reference to the related disclosures, if any, in the financial statement. So if there is a note with respect to the, say we'll take the same example, impairment of assets. If there is a note by the management stating impairment of assets, now there is a distinction here. If impairment of asset is applicable, however the management has not done the impairment, if there are indicators of impairment but the management has not done the impairment, then it is non-compliance, then it calls for a qualification. We are not talking about that. If there is an impairment of asset which is there and the management has done certain impairment, or it has taken based on certain evidences, it has substantiated that it is not necessary to do the impairment, and we have tested it based on evidences that are available to us, and then based on things that are available to us, then we concluded that impairment is not available, is not appropriately disclosed in the financial statements. Those are the things that we are talking about. So if they have given a detailed note in the financial statements, then our CAM has to refer to the said note also. And then it should also address why the matter was considered to be one of the most significant in the audit and therefore determined to be key audit matter, and how the matter was addressed in the report. So the CAM actually starts with, this is CAM and this is the explanation to CAM, and then we will have to write why we consider as auditor, why we considered it as CAM, and how the matter was ultimately addressed in the audit. So we have to give the audit procedures. So a simple summary or a brief summary of the audit procedures. So generally it is the practice that we write that our audit procedures on the said matter were included but not limited to so and so. So that is the type of audit procedures that we write. And very important point to note is we never conclude on any matter, because on individual matter that is being given as a CAM, we are not supposed to provide a separate opinion. That is not what is required by the standard or by the Act, Companies Act or anywhere. So CAM is an important matter that we have discussed with TCWG. We are bringing out that this is a key audit matter. We are stating that this is the basis because of which we have considered this as a key audit matter. These are the audit procedures we have provided, we have conducted, but we cannot express a separate opinion on that, because opinion on the financial statements have to be seen as a holistic one. We cannot say that okay, impairment of assets is concluded satisfactorily, or we have the company has provided satisfactorily, something of that sort we should not conclude. So there is no separate opinion on the section, it's a overall thing. So when we talked about para number 14 and 15, which actually otherwise if not allowed, then we should not give a KAM. So what are those para 14 or 15? So auditor shall describe each key audit matter in the auditor's report unless law or regulation precludes public disclosure about the matter. The matter is highly sensitive. So the law or regulation says that you cannot publish it in as a published public disclosure. So it precludes public disclosure. Or in rare circumstances, the auditor has determined that the matter should not be communicated in the auditor's report because adverse consequences of doing so would reasonably expected to outweigh the public interest. So we started with the thing saying that CAM will provide better transparency, it will provide value add to the report. However, if we conclude that the presentation of KAM will have higher adverse effects and it will outweigh the benefits of providing it as a CAM, then we should not give it. But it is extremely rare circumstances. So if at all we conclude that this is the case, then our documentation has to be very strong to actually support this conclusion and to document why we have not given KAM. And also it is necessary that if there is no KAM, we have to write that there is no KAM. Interaction between descriptions of key audit matter and other elements required to be included in auditor's report. So that is if there is a disclosure in the financial statements, if there is anything else that is related to key audit matters, we have to bring it out in the audit report very clearly. Having understood what is a KAM, let us look at a step-by-step approach to how we determine a KAM. So we have a bucket of lot of queries. From the lot of queries, we come down to few queries that we discuss at the partner level or with the TCWG, that is the board and the audit committee of the company, or the CFO and the CEO, and the board and the audit committee of the company. So we come down to that, narrow down to that portion. So say there are 4 to 5 matters. Out of that, we then decide what are the matters that are requiring significant auditor's attention. So out of the 4 matters, then we then finalize on, narrow down on which are the matters that are required of significant auditor's attention, and then we narrow down further on what is the most significant one for the audit. So we have 10 matters, out of which we have precluded 5, and then out of the 5 we again think which are significant, and then we narrow down on what is most significant. So from the total population, that's how we narrow down. Another important thing to note is it has to be in the context of the entity. It should not be generalistic. So one of the examples that I can state here is a new adoption of a standard. Say for example, this year 116. So 116 is a new standard. It's a complex accounting matter. So the KM cannot be a generalistic one that we have adopted 116 and the audit procedures are standard. No, we need to give what was it specific to that entity. How did that entity make any significant judgment or estimate with respect to 116, and how did it disclose with respect to that? And that's how it becomes a KAM. Only by applying a new standard or applying a new regulation doesn't become a KAM. It has to be seen in light of how that specific entity is handling it. So then it becomes a KAM. So it is in the light of that entity, we have to identify the matters that are of more significance. One thing that was there last year was there was a KAM on 115. So KAM on 115 is good, but then it's not necessary that we give a generic KAM because a new standard has been applied. So in 115, Ind AS 115, it has to be specifically looked into as to what is the KAM that I am looking at. It may be a warranty provision, it may be breaking up of a contract, it may be post sales agreement that we are looking at, or whatever. So that case has to be, or that estimation has to be brought out specifically, that involves significant management estimate or judgment. So factors that have to be considered at each stage of the process. So the decision stage matters communicated with those charged with governance. What is the factor that we have to consider? A number of ISAs actually include requirements that determine the nature, timing, and extent of matters to be communicated with those charged with governance. So let us take examples. Which are the things that have to be communicated to TCWG? If there is any material or significant control failure, that has to be as per guidance note on IFC, and as per ISA 315 and 330 also, SA 315 and 330 also, it has to be reported to DCWG. Other than that, what else is to be there? As per SA 240 also, if there is any matter that is susceptible to fraud, and then if we feel there is anything, now I'm not touching upon 143.12 here because this is only indicator. 143.12 of Companies Act is specific fraud there, and then if it is below 1 crore, then you have to intimate board, and then if it is above 1 crore, board and the central government, so on and so forth. But if we restrict it to the indicators of fraud, then there may be certain matters that we may have to discuss with the TCWG. Similarly, in every standard there is a list of things that we have to discuss with TCWG. So in appendix 1 of 260 there are many cases which are given as discussion with TCWG. So not all those matters that has to be communicated with TCWG. Say for example, it also gives independence declaration.
मैडम बोलिए
Yeah,
मैम।
I was being shown as muted, so yeah, thank you. So all those matters, say for example 260 tells us that you have to provide declaration of independence, you have to share planning with the entity, so on and so forth. So all these matters do not become part of KAM. So that is the important thing that we have to note. Matters of significant importance that we discuss only becomes KAM. So step 1 is we have identified the list of matters that are to be discussed with the TCWG, out of which we have narrowed down as the funnel. We have narrowed down matters that require our attention significantly, and then matters of most significant attention. Then SA 701 requires us, that's the engagement teams, that's the audit teams, to take into account three specific types of matters. Areas of higher assessed risk of material misstatement or significant risks identified in accordance with SA 315. So based on SA 315, there are always presumed risk as per any methodology that you use. There is always two presumed risk. One is fraud and revenue recognition, and second is management override of control. Largely, these two will be significant risks, but not necessarily that every time these two will become KAM. If you can rebut these risks, then you can, go ahead also. Further, if there are other risks that you have seen in terms of any company, then that may become a KAM. One best example in the given scenario is 31st March, your SA 501505 a confirmation and inventory verification and all that says that you have to attend inventory verification unless it is impossible for you to do that. Now, our institute has also come up with the guidance in terms of alternate procedures. There are also other bodies like AICPA and all of them also have given certain guidance. So this video conferencing inventory verification also that is suggested. I'm not sure how successful it is or how it is being able to see. So these may be items of if your inventory is significant in the financial statements. I'm sure all of the manufacturing or larger entities will have inventory significant amount in the financial statement. So if you have significant inventory in the financial systems, then what is the alternate procedure that is suggested? Alternate procedure is if you have a perpetual internet system, if you have a perpetual inventory system, then it is a different case. If you have a continuous inventory system or if you have a year-end inventory system, then the procedure is different. If you have perpetual inventory system, you will have to do roll forward if the inventory is taken before this lockdown and a rollback. And in case of year-end inventory, then you will have to do a rollback whenever the operations are assumed normally. So that you will have to check and then you will have to do. So if the inventory is material and you have done alternate procedures, so then it may warrant a KAM because it is a significant matter and it may be a matter that may be necessitating a requirement or discussion with the TCWG as well. So you will have to state what is it that you have done, how is it, why do you think it is a KM first of all, and why is it significant to the financial statements, then the audit procedures that you have applied. Now, given the same case, if you by rollback, if you are not able to obtain sufficient appropriate audit evidence as required by SA 700 to give your audit opinion, then you will have to qualify. Now, giving it as a KAM does not actually act as a substitute to your qualification. Wherever it has to be a qualification, it will have to be a qualification and you cannot give it as a KAM. So assessed risk of material misstatement is the starting point. So in the current scenario, I just try to elaborate or give an example on how it is. So even in case of Ind AS companies, if there is significant delay in payment in receipt of money, if there is a lot of expected credit loss that is expected there, and if the provisions are made on a certain basis or certain assumptions, then how have you evaluated those is another case where you can do a KM. Third case may be like banks are giving moratorium of 3 months for the bank's balance sheet where it is listed, so advances may warrant a KM where it is said that this is the effect on the moratorium, maybe I have made a provision of this much, not made a provision of this much. So there was a statement by RBI governor also in the morning about some provision by NBFC, by bank and NBFC, where to yet see the notification as to how that will evolve. So whatever is that, so that becomes, if there is a significant judgment involved, there is a significant this thing involved, then you will have to do a KM over there. Then significant audit judgment relating to areas in financial statements that involve significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. So that's this COVID-19. I gave various examples of advances. I gave various examples of ECL. So all these are judgmental basis things. So this has to be looked into in terms of SA 701. Otherwise, significant events or transactions that occurred during the period that had a significant effect on the audit. So that also, the current situation also fits into the third category as well. What is the step 2? Matters of most significance to the audit. Factors for consideration when we determine what is most significant. Significance of interactions between us and TCWG what is the frequency of discussion of this matter, how did we conclude, how much significance was it attached to, how many, how much impetus did we do on it. So it matters a lot to be a lot of to and fro in that. Importance of the matter to understanding financial statement as a whole. So what is the importance of the said matter in terms of financial statements? Something may be a non-financial statement item, but then we are deliberating on that because that may be important. But then we need to also understand whether it is very important in terms of the financial statements. If it is very important in terms of significant in terms of the financial statement, then it may then fall into the step 2 from the step 1. So that from the 5 point to the 2 points that we are ultimately mattering. And obviously materiality, needless to say, if the matter has to go to TCWG, I assume that it has to be material, not smaller items of, say for example, if a company is having a turnover of 2000 3000 crores, you will not be taking 150 rupees 500 rupees items to the board. You may be taking something like 10 crore 15 crore item to the board, because your materiality itself will be higher in such cases. So the materiality of the matter does have to be taken into consideration. Nature and extent of corrected and uncorrected misstatements associated with the matter. So if the underlying matter has corrected misstatements, if it has uncorrected misstatements which are not ascertainable and which is below PM, so that also has to be evaluated. If there is an item which has more of corrected misstatements, so that means there is a lot of mistakes where you had to identify, unearth, and then you will have to get it rectified. Maybe that is of significance that you want to disclose in your audit report as a CAM. Complexity of accounting policy, we also discussed about 115 116 new accounting policies, or if there is an existing accounting policy. So as we know that accounting standards do not have accounting available for all kinds of situations. There are certain customs and practices that prevail, and there are certain things that we do on the basis of how we understand the accounting also at times. So if there are complex accounting matters, if there are certain things that are to be seen as how these things are to be concluded, then those are the matters that will form part of the CAM for you. Nature and extent of audit effort undertaken. Obviously, given the above all indicators, we very clearly understand that the nature and extent of audit matters is very high, because the nature, if this much of complexity exists, then obviously the amount of audit that we are going to do on the said subject will be higher. Amount of audit procedures that we will be applying will be very higher, and there will be a lot of challenging on the subjectiveness. There will be a lot of to and fro on the discussions and things like that. And then existence of severe control deficiencies related to the matter. So if there are control deficiencies, how we have identified, how we have concluded. Now this again, if there are control deficiencies, it can be a matter of if it is severe control deficiencies, it can be a matter of IFC reporting. It's not a qualification in the IFC reporting. Again, reporting it as a KM is not a substitute to the IFC report qualification. And then there may be matters with multiple audit implications. So there may be certain so management overhead of control, that is the best example. It has multiple audit consideration. So if during the year, if we find anything related to this, or if anything related to JEs and all, then it may be a matter which has to be seen with more impetus, and we will have to classify it as a CAM. Let's look at some of the examples of CAM. What all can be a CAM? Lastly seen, CAMs are impairment issues regarding intangibles. Basically impairment with respect to the intangible assets, especially the copyrights and the trademarks and all these stuff are largely present. Now there is a database also that is available on, I think, some website, I forgot the name, where they have complied internationally few of the camps, and that is readily available. Our WIRC has come up with that publication of that anthology of KAM, where we have compiled a lot of Indian audit reports, and kind of we have classified the qualifications, the KAMs, so, and we have given references to various reports also, the company name, the matter, and everything. So languages can be picked up from there as well. Another matter is of deferred tax issues. Example, valuation of deferred income tax positions, deferred tax assets. So that's a matter of KM, because there is a lot of judgment that is involved there. Then matters connecting to restructuring or judgments on acquisition of entities. So it's a given that during the year, if there is a merger, or if there is a acquisition, or if there is a business combination, there is a KM with respect to it on the significant judgments that is applied on the certain things that we have applied during the year, and how the accounting has been done. Again, here, if there is something that is not in line with the accounting standards of the Ind AS, and the qualification has to be made, then the qualification is necessary. And KM is only indicative of certain things, it is not a substitute to qualification. Accounting of certain provisions, for example, the retirement benefits, if at all, if it is significant, significantly matter, if it is significant matter, and if it is necessary, then you have to do a KM on pension provisions also. This is largely seen in terms of the European and UK audit reports. I have not seen this in our reports much in the last year when we did the compilation and we read through a lot of CAMs there. Accounting for financial treatments, financial instruments, yes, 109 has so many varieties and so many options, and then so many accounting complexities that are involved. So if there is anything that we have to be aware of, then we have to be making a KM towards the accounting of financial instruments, and not necessary if it is a simple one. And if there is any complication with respect to the complicated accounting management estimates judgments that we have undertaken, then we have to have KM with respect to that. Valuation of any kind of illiquid assets and liabilities, that is another area where many of the CAMs are found. If there is a valuation of certain assets which are which involve certain management estimates and judgments. Valuation of accounts receivable, we discussed about ECL, that is the expected credit loss, in terms of if there is anything, and if there is any judgment, if there is any provision estimate, otherwise also if it is necessary, then it becomes a matter of KM. If it is of higher significance, and if it is of matter that is involving TCWG involvement requirement. So this is not for all the accounts receivable normal provisions, which are more of routine in nature or as per the policy of the company. We discussed about specific accounting treatments where there is no specific guidance available under AS, Ind AS, or even IFRS, and then there is the custom or practice that are being followed. Say, for example, in terms of if there is an if there is a company which is producing, which is actually producing fertilizer and things like that, so they get certain grants by government. So they accounted in a very typical manner, because certain things they get only after fulfillment of certain conditions. So those are industry typical matters which are actually industry specific accounting treatments that are there. Similar thing is there are certain type of requirement in some other industries, so in kind of textile industry, and also those are the typical accounting treatments. If those are there, then it is better to bring it up as a KM, because it's not a matter of qualification, but it is always better to be transparent and be doing a value addition in the audit report. Significant risk related to fraud in revenue recognition. So this is from the risk area that we are doing a KM. So if there are significant risks relating to revenue recognition, if we are done the audit, and then if we have completed the audit on the basis of it, then it may warrant a KM. And last year it was many companies had given, because it was first year of implementation of 115. But it is not only from the point of view that it is first year of implementation of 115, but it also has to be specific to the company itself. It cannot be a generalistic one. Other revenue recognitions, not fraud, obviously. If it is relating to fraud, and if there is a specific fraud that is identified, then it goes to a different level. But other revenue recognition issues, if at all you have any. Management override of controls, we discussed this very much in detail. I think management override of control, if at all there exists, and then if we have encountered it and we have done the audit to satisfy, then we have to give a KAM with respect to that. Segregation of duties is again a KAM, but insufficient segregation of duties may warrant a qualification in our this thing also, in our IFC report also, because that is one of the elements of COSO. Dependency on information technology. This is a very interesting thing if there is a complex information technology environment. So if you have to get done the ITGCs, and largely all of your controls or significant amount of your controls are dependent on IT. Say for example, in a complex financial services entity, many of the things are system driven, then maybe you will consider giving a KAM on ITGC itself. So that is one of the things that was seen as a common KM in many of the entities, in few of the entities in India, but many of the entities abroad. So other considerations in terms of KM, identified KMs are, they are specific to the nature and activities of our client. They are not generalistic in nature. They are relevant and meaningful to users. So it is not something that someone else has written, so I want to write. So it is very specific and it makes some sense to our users of the financial statements. It's not generalistic, and it's not a thing that we have to write a KM, so we are writing it. And it is considered from the planning stage onwards. So it is something that we thought of from the beginning, right from the planning stage. So something like a from the SA 315, where you identify risk of material misstatement, and then you conclude that there is no risk. So there is something that had been on your mind right beginning of the audit. It is not a KM, it is not boilerplate descriptions. So you cannot actually do something, write something, and then leave it half in the air, saying that you read it and get further confused. So we cannot do something that actually is not a value add but a confusion to the financial statement users. A discrete opinion for each KM. So we cannot have individual opinion, as we discussed, for each KM saying that we have concluded or we have opined, we have satisfactory. It is not a substitute for modified opinion. So it is not at all a substitute for a qualification or a EOM. And it is not a substitute for financial statement disclosure. So it is not that, because the distinction of the responsibility is divided between the financial statement preparer, who is the management, and the auditor who has audited it. So it is not a substitute to financial statement disclosure. Something that has to be a financial statement disclosure has to be there, and we can only opine on it. So our report or inclusion of any matter in our report is no way substitute to financial statement disclosure. It's not a substitute for reporting a material uncertainty related to going concern. So as per SA 570, we have a distinct para on material uncertainty relating to going concern. If it is a material uncertainty relating to going concern, so in the given case, in the COVID-19 situation, there are many entities which are already loss making, or which are net worth is eroded. We have seen there has been a lot of companies wherein there are companies which are having this situation, and then they were already on certain funding from their investors or from the holding company. Now, as the entire global economy is affected, one thing that is very important to see is that if any of the company has a support letter from their holding company, it is very important to assess the holding company financial statements also for the financial healthiness. So the person who is supporting another person himself, if he is having financial issues or crisis, then this company cannot fall back on that. So the material uncertainty on going concern may come up very heavily. So obviously that is not a KM, but it is a separate standard. But in the given situation, this is of higher importance, that going concern assessment at the beginning of the year. So as per SA 570, we have to do going concern at the beginning of the audit and then at the end of the audit. So we may have done a going concern at the beginning of the audit, which may have been positive, but then at the end of the year when we do, if we have any indicators, we have to look at it. But if for entities at the planning stage only, if the going concern is doubtful, then maybe by end of the audit we have to be doubly sure as to whether we want to qualify or disclaim or otherwise. So this is one area we need to specifically look into. And KM is never matters that are unresolved by the auditor. So the pending issues or brought forward issues or carry forward issues are never KM, and those are not substitute to audit reports, modified audit reports. Each KM description must include, so we are kind of illustrative format as to indicate ABC. What is the description of the key audit matter? So it has to be a statement of fact. Usually this will include the title of the KM, and this is the example, like impairment of loans and investment groups charge amounted to so and so. Why did the audit focus on it? So we have to explain our rationale as to why did we think that this is a matter that we had to discuss, and what is the reference to the related disclosure. So refer note number so and so the financial statements, or as referred to in the financial statements. So that is a better way of presenting a KAM. So I have also reproduced an illustrative key audit matter. So that was a description of the KAM. So we are talking about group's intangible asset amounted to so and so, and then we have given B, why did the audit focus on it, and then what is the reference related to the audit disclosure. So that's a illustrative key audit matter, how it looks like. Now coming to the next part of the KAM, audit procedures. How do you describe audit procedures? There are 4 options to it. The first one being aspects of the auditor's response or approach that were most relevant to the matter or specific to the assessed risk of material misstatement. So whatever audit responses that we have, whatever tests that we have conducted, a brief summary of the test or a brief overview procedures performed, or indication of the outcome of the audit procedure. So no specific conclusion, but indicator only, and key observations with respect to the matter. So it can be either these 4 or all these 4 put together. So generally the way we write the audit procedure is our procedures were included but not dated to verifying the test of controls on a test sample basis, on a test check basis on so and so, and then identifying, verifying the controls, and then looking at the management estimate with respect to dash and so on and so forth. So we write in brief 6 to 7 procedures, and that's how we do not give any conclusions specifically to a KAM, but we write those 6 to 7 procedures and then we close the KAM. We should not ever use a singular opinion on each of the matters. We should not be giving an opinion on any of the item in the KAM. So these are the examples. So we are not supposed to write something like the words are highlighted or underlined here. So we should not be using something like we are satisfied with the provision. The provision seems to be appropriate. So we cannot be concluding like that. So the said amount is acceptable to us. The said provision is acceptable to us. It is appropriately accounted for. We concur with the management. So these kind of words have to be avoided, because opinion we are giving as a whole and we are not giving in parts or on each of the matter. So we should not be giving something that has to be individualistic on each of the KAM. Another thing with respect to providing of KAM is, if there is only one matter, we can provide it in a descriptive manner. But if there are more than one matter, there are reports where there are 2 to 3 KAMs. For better presentation, we can put it in a table, and then we can say that description of the KAM, and on the right hand side we can put the audit procedures performed. So it is only for the presentation purpose. So no one stops us from writing in a descriptive manner only, but then it has better presentation if we put it in a table. Other considerations when we write a KAM, examples of auditor reporting innovations in the context of KAM, that is KAM being presented in tabular formats. There are some countries which also use graphical approaches on year-on-year comparison. So this is the second year for us but then some countries are using it from 3 to 4 years, so they have given a graphical representation of the figures involved also. So I don't know, after a year or so we can think of doing it, but right now it's just the second year for us. KAM considered as being other recurring or event driven risks, so they have categorized it into recurring KAM and then new KAMs also. So I think that's another innovative idea. Audit firms also disclosing KAM section and what and how these matters have been reported to audit committee. So what is the mechanism of reporting, how they have reported and all that stuff. So they have improvised year on year. We were in the first year, so we were just drafting the way we understood. Then second year is now like we have reached the next level. Now I don't know, third or fourth year, maybe we want to do a graph or we don't want to do a graph. Let's see how we evolve. How do we document KAM? So as we understand, and we as practicing chartered accountants, mostly we always believe that something that is not documented is work not done, and it applies to all the areas. And KM being one of the significant matter, we need to actually establish a trail as to when we have identified, how we have identified, how we have carried forward, and how we have concluded whether it is a KM or not, and why we have concluded that it is a KM or not. So we have to document our rationale for why we have determined that certain matters were KM, or if applicable, why we determined that there were no KM. So if there is no KM, we have to write that there is no KM. So out of the matters that were reported to TCWG, we need to write whether anything is a KM or nothing is a KM. If yes, also explanation. If no, also explanation. So that is very important. I think that's largely about the description of the KM and how to document the KM as well. There is an implementation guide on SA 701 as well, which actually answers many of the questions that while drafting any KM, it comes very handy and it's very useful. So few of the things that I have tried to put it here as an FAQ or picked up from there and for a ready reference. Which audit it is mandatory to? At present, it is mandatory to general purpose financial statements. So any special purpose financial statements, it's not applicable to. So SA 800, it is not applicable. If you are making December year end general purpose financial statements, and if you are making tax accounts in 31st March, then it is not applicable to 31st March tax accounts. It is applicable only to general purpose financial statements as on 31st December. A date of applicability from last year, pertaining to financial period beginning after 1/4/2018. Applicability to interim financial statement, no, it is not applicable because it is specifically stated that it is for general purpose financial statement, and interim financial statements are not general purpose financial statements. Early adoption permissible, no, and it is of less relevance now because we are sitting in the second year. Whether it is applicable to tax FS, as we answered, no. Applicability to listed companies, listed status as on reporting date, yes. If it is delisted during the year and it is notified as delisted, it's not applicable. If it is under the listing process, as such, not applicable, but the company may decide, the auditor may decide to give, and then it is a better disclosure. If it is securities listed outside India, then also it is applicable. So if for a company, it doesn't have a security that is listed in India, but if it is listed outside India, then CAM is applicable. Applicable to different type of opinion. If it is disclaimer of opinion, we all know that in case of disclaimer of opinion, there is nothing further that we are required to do. There cannot be an EOM, there cannot be a KAM in a disclaimer of opinion, because already we are saying I don't know what is there. Qualified opinion, it is applicable because qualification may be on a different matter and KAM is on a different matter. Adverse opinion also, it can be applicable if there is matter of such significance or importance. EOM, it is applicable, but it is not a substitute to KAM, but in rare cases, EOM and KAM on the same subject may coexist. If there is no disclosure with respect to CAM in FAS, in financial statements, it does not relieve auditor of the requirement to do the to present the KM. It has to be presented even if there is no disclosure. If there is disclosure, then give a reference to the disclosure. Whether it can be different for different years, yes, it can be, but unlikely because the practices are followed. There is a new standard or something, then it can definitely be. Different entities in same industry, possible to have different KAMs, but generally industry specific is also there, but then it can have other matters also. Significant risk, whether all significant risks are KAMs? No, it has to be individually assessed as to which is a KAM and which is not a KAM. All matters communicated to TCWG, whether it is a KAM? No, you have to individually evaluate which is a KAM and which is not. Whether there can be a scenario of no KAM? Yes, possible, and we have to state the fact that there is no KAM in the audit report itself. Whether there can be only qualification? Yes, of course, but then we have to state that there is no KAM at all. Whether going concern is a KAM? No, there is a specific standard guiding it, and there is a material uncertainty para attached to it, so we need to be guided by that. Order of KAM, there is no specific order. Whatever is the highest significance, you start from there and then you start writing. Is it applicable to console FS? Yes, to the parent, and if it is applicable to the components, then it is to be compiled on the overall basis in the console FS. Whether it is applicable to joint audit? Yes, if it is a listed entity, if it has a joint audit, then it is applicable to each auditor on their area plus the collective areas, if any. What are the reference documents that we have today available? There is SS 701, there is implementation guide to 701, there is anthology on KAM and other reporting matters in audit reports. So all these are reference documents available to you readily. Any questions?
If there are any questions, can you just put up those questions? Are there? Okay.
So Padmashri, the questions are here.
Sure that if there are any projects which we can close, we can do that.
Yeah.
Even if it is a lesser phase. Third one
As
is
per
making sure that
116,
we are not
if you are
lacking
required
people
to
on board
streamline the
unless
contract
we have
revenue, can this be considered as a KM for the purpose of reporting? Yes, it can be because it involves certain judgment, and then how it has been applied and how it has been considered and then concluded, it can be a matter of KM. Whether COVID-19 is KM, whether its impact is to be reported in audit report, I think we explained it very much in detail. So COVID-19 as a general situation is not a KM. How it has impacted which area? So for example, if your revenue is affected, then there has to be a KM on that area. So it's not a generalistic one that there was a situation of COVID in March and then there were certain measures that were taken. So you have to either say there was amount that was ascertainable, management has done certain provision, has earned or not earned, or we have done certain thing, there was a fraud in the company due to COVID, whatever that we have to specify. If it is a qualification, it will go to the qualification. If it is otherwise, then it will come as a KM. There can very well be a KM on account of COVID-19, and I foresee how I understand and foresee is that almost all the large companies report there will be area-wise assessment of COVID-19 impact, and there will be a specific KM with respect to it as to how we have looked into it as an auditor. When KM is spotted in internal audit reports, how is it captured, and should we state that this is alert is from internal audit? Okay, so how we look at it is that we do not pick up or spot KM. It is that through the audit or right from the planning of the audit, there are significant matters. If we have not come across that matter, and if internal auditor suggests that there is a matter which is actually a matter of KAM, which we also want to look at and we also want to ultimately comment it. Hello.
Yes, please carry on. I think you are audible. Yes, please carry on.
I got a message.
ma'am.
Yeah. So thanks. So so even if it is coming from an internal audit report, ultimately, if it is a matter of importance that you have discussed with the you know TCWG and you have done the audit procedures, then it can form part of KVM. But it is not necessary that you have to state it that it is coming from internal audit. You can also include that this was also included as an internal audit observation. You can state that, but it's not necessary that that is the source, because ultimately you are the one who is deciding and it's your audit report. You have to take a call whether you have to include it or otherwise.
So these are the few things.
Reporting under 143.3.1 on ICF are applicable once applicable forever, or we have to evaluate it on yearly basis based on previous financial years. So there is an FAQ on that. You will have to determine it on the basis of last year's financial statements. So if you meet the threshold, it will be applicable or otherwise. Can impact of COVID-19 on financials on data's recovery considered as a KAM? Yes, if it is significant and if there are provisions or estimates that are made in relation to it, it can be a KAM. As we all know that existence assertion of the data as on balance sheet would be tested cause of COVID-19. I'm just losing that screen. Can you click on the screen, please? Question wala screen. It's blurred completely. Yeah, thank you. As we all know that existence assertion of the data on the balance sheet would be tested. Yeah, it can be based on the provisions, based on the existence. If you had to do additional procedures, it can very well be a CAM for you. Drop in revenue, say 10 to 15% drop, a matter to be included in KAM. A mere fact that there is a drop in revenue does not warrant a KAM. If that is coupled with other factors which actually have made you test more, or if there is any judgment or estimate by the management which you had to look at or you had to verify more, then it will become a KA. A share broking company maintain tally accounts by doing only quarterly closing journal entry from IT software approved from stock exchange. Whether it is required as KAM. I did not understand this question. So if it is maintaining accounts in tally, whether it is KAM, no, it can have its books in tally. And if it is doing quarterly on the basis of stock exchange shareholder this thing, it's not necessary. But if it is quite complex where you have to do a lot of things, then you can state it as a KAM. KAM reported for 31st March 2000 says on Ind AS 115, whether same need again to be reported in. So that depends on what is your assessment. So that is when I said that if it is a generalistic one, that Ind AS 115 was time implemented and then a KM on it, then it will not matter that you have to repeat it. However, if it talks about certain judgments, assessments that you have made by implementing Ind AS 115, then you will have to see that was recognition. Now you will have to see every year recognition, measurement and things like that, and then you will have to accordingly see what has to be your KM. If company has followed new depreciation method till date but wish to shift to new method from 1920, can the shift and difference in depreciation methods put in KM? If it is non-compliance with accounting policy, or if it is non-compliance with accounting standard, it can be KM if the matter is material and significant. However, if there is any non-compliance, or if it requires restatement as per Ind AS, then it has to be a separate statement altogether. It cannot be a KM then. Since 701 is mandatory only for listed companies, whether it is applicable to audits of unlisted companies? No, the answer is in the question. It is only applicable for listed companies. Due to COVID-19, stock verification is not conducted, but the same is determined based on backward calculation post-lockdown, whether matter needs to be reported on KM. This is the specific example we discussed, that due to lockdown, if you're not able to verify the stock, then if you do the rollback procedures, if the amount is material, significant, which has involved TCWG, then it has to be a KM. material capital gains transaction, that is sale of subsidiary, requires KAM reporting. Yes, discontinued operations, if it is a discontinued operation, it's a different standard altogether. It requires different disclosures, but it can be a KAM there also. And then any kind of merger, demerger, sale of significant amount, significant entity operations, Ind AS 103, all these generally are a matter of KAM. If a company has its securities listed on a foreign stock exchange but has no listed in India, is the auditor required to communicate KM as per SA? Yes, if you have foreign listing, it's required. KM is required. If the audit report has a qualified opinion on almost all matters, then can KM state that there are no other matters to report? Okay, so it's like you have a lot of, if there are, actually the answer is slightly different, because if you have a qualification on almost all matters, actually it should not have been a qualification, it's almost a disclaimer of opinion. You need to think about whether you're issuing the right opinion. If you are still going with qualification, you can say there is no KEM, but if you're giving disclaimer, you anyways come to the conclusion that there cannot be a CAM on disclaimer.
So I think we are done with the questions, Mishra ji. Okay, so Padma Shri, we had an excellent session from you, very in-depth in CAM, and I think you touched upon every question and every aspect of CAM. This is very, very helpful in current times. The other thing is the other session that you took, the earlier session, which was on the updations on Companies Act or the amendments. I think that is also very helpful in current times and even otherwise. And as auditors, I think we really need to know all the laws, all the updations, and this has been a great contribution from your side. And you made an excellent presentation in current times, especially when we all have to work from home. You have made an excellent presentation. Thank you so much for your dedication and your effort. And I think now with this, we can move on to the next session. Our next session
Thank you very much,
is
ma'am.
on. Thank you so much, Padma Shri. Thank you so much. Okay, so we move on to our next session, which is on Ind AS 115, which is again a burning question, as Vishal Bhai has just in the opening remarks said, especially for March 20, everybody would want to push some sales into the year, but now let's see. So for that topic, we have a very learned speaker with us, Ms. Vaijayanti Mala Bilsare. She is a partner in MSK Associates. She has had 18 years of experience in audit assurance services, especially audit of financial statements and accounting advisory services to attest and non-attest clients. She has worked in various roles in Mumbai office of large accounting firms serving multinationals and Indian corporate clients. Her work experience spans across multiple key industry sectors, and she has been a speaker or an instructor for seminars on auditing and accounting standards conducted by the ICAI. Her industry expertise is manufacturing, including FMCG, consumer electronics, consumer goods, pharmaceuticals, IT, ITES, media and entertainment. She's a chartered accountant, and she has done her MBA at ISB and a certification course from Wharton School of UPenn. And I think this is also not enough to describe her expertise, but now I would request Ms. Bilsare to please take over the session and express your views on Ind AS 115. Over to you, Ms. Bilsare. Thank you.
मिश्रा जी, अभी उनके साथ में स्क्रीन शेयर करेंगे।
आ रहे हैं सर।
So I request the participants to hold on for a few minutes. I think we were facing some network problems with the second speaker, but give us a couple of minutes and we'll get started.
In the meantime, Mr. Mishra, can we just play the video on ethics that we could not play in the beginning if we are ready with it?
Hello.
Speakers
Sound
there,
आ रहा है?
so fine. Yes, 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 very well.
Okay, just give me 2 minutes. I'll start my presentation. There have been some internet issues. Just 2 मिनट दीजिए हाँ. अभी मुझे फाइल ओपन करना है ना. फाइल कहाँ से? एक सेकंड मैं फाइल ओपन करती हूँ. फाइल तो ओपन हो गई, आपको दिख रही है? तो आप ले लो कर. फाइल ओपन करिए मैंने. और मुझे कुछ करना है और फाइल मैंने ऑन कर दी, ओपन कर दी है. हाँ. ओके तो पीपीटी में आपको मेल करूँ क्या? मेल हो गया है पीपीटी. हाँ. फाइल त्यानं बंद करायला सांग ना. नको मला, माझं चालू आहे. आपको मिला पीपीटी?
मैम आपका माइक ऑन करके बोलिए.
Can you unmute, Vaijanti? Can you just unmute yourself, please?
अनम्यूट हो गया? हाँ okay हाँ sure
दृष्टि मैम स्टार्ट करेंगे मुर्तजा सर।
yeah am I audible?
Yes,
Hello.
yes, you are very clearly audible. Yes,
Yeah,
please carry on.
extremely sorry because I think we've been having internet issues since last 2 days, and that's the reason I think I just lost the connection. So, welcome all of you to this session on INDES 115. This INDES is just come about and is effective from 1st April 2018. This INDES is pretty complex and pretty, if you can go to the next slide, please. This INDES is pretty complex, it's very lengthy and it's interconnected. The points are interconnected. So I'm going to explain the core concept of this INDES, and then if there are any questions, we can take it at the end of the session. So the broad structure of this standard is, it just spells out the objective, scope, the recognition and measurement criteria or the principles. It talks about contract costs. It talks about the presentation and disclosure. It has 5 appendix. The appendices basically chalk out the definitions of various terms in the contract, in the standard. It gives application guidance on certain principles. It gives the effective date and transition provisions. It also talks about service concession arrangements and the application guidance thereon. Next slide. The objective of this standard is very critical and very clear. Basically, the standard wants the entities to report useful information about the transactions on contract with customers to the users of the financial statements about the nature of the transaction, the nature of the contract, the amount, the timing, and the uncertainty of revenue and cash flows arising from a contract with a customer. The core principle is that the entity has to recognize revenue to depict or demonstrate the transfer of goods or services to the customers that reflect the consideration to which the entity expects to be entitled to in exchange for those goods and services. This is the principle that is basically to be held throughout the standard when looking at various provisions. Another consideration, key consideration, is that the entity has to look at the terms of the contract, all the relevant facts and circumstances of the contract and the case at that point of time, practical experience applied consistently to contracts with similar characteristics and circumstances. This INDES 115 replaces 2 INDESes. One was INDES 18 on revenue and the other INDES 11 on construction contracts. The next slide. This standard applies to all the contracts with customer except for leases, insurance contracts, financial instruments, certain arrangements coming out of the financial instrument contracts, certain non-monetary exchanges, and income not arising from contracts with customers. To that, this INDES does not apply. Who's a customer? Basically, if the counterparty is a customer only if that has contracted with the entity to obtain goods or services that are the entity's output in exchange for a consideration. A counterparty is not a customer who participates with the entity in a particular activity, shares the risks and rewards of the activity resulting from the activity, and not obtaining the output for a consideration. This INDES does not apply to these contracts. Next slide. Contracts that are partially in scope of INDES 115 and partially in scope of other standards. There are certain contracts to which the provisions of other standards also may be applicable at some point of time, and how do you deal with these provisions? So in case you have a case like that, you measure one or more parts of the contract or separate parts of the contract as per the other standard. So if the other standard is telling you to segregate an element, of a contract with the customer that pertains to the other standard, you should first segregate that. Given that the other standards makes a specific requirement to measure under a particular criteria given in that standard. Exclusion from the transaction price, you should exclude from the transaction price the portion measured in accordance with the other standard. So if you have a transaction price specified in a contract with the customer, and other standard also specifies exclusion of a part of it to which the other standards requirement are applicable, you should first exclude that portion from the transaction price. Allocate the transaction price after the exclusion that remains to the performance obligations within the scope of Ind AS 115. In case other standards do not specify how to segregate or separate the elements or initially measure parts of the contract, the entity has to separate and initially measure parts of the contract as per Ind AS 115 only. Next. It also talks about incremental costs of obtaining a contract with the customer and costs incurred to fulfill the contract with the customer, which is coming in the contract costs. It applies to those costs that are incurred and that relate to the contracts with customer within the scope of this standard. This standard is effective from 1st April 2018. Next. If you look at the structure of the standard, which gives the recognition and measurement criteria, there are 5 critical steps. These steps are: identify a contract, identify performance obligations, determine the transaction price, allocate the transaction price to the separate performance obligation, and recognize revenue when the performance obligation or performance obligations are satisfied. Next. Now let's start with the step 1. The standard requires us to identify a contract. So what are the criteria? How do you identify a contract? Contract identification has to go through certain criteria which are specified in the standard, which are 5 criteria. First is the contract or an arrangement has to be approved by the parties, which means there can be a written contract or a verbal contract or a contract which is implied by certain customary business practices. Basically, there are certain contracts which have to be written between, which are formal contracts between 2 corporate entities or an individual and an entity, or maybe 2 individuals also. There could be contracts that are verbal in nature. Say suppose you give a call to your grocer and say that you need to send me certain grocery items, and he says yes, by the end of the day I will send you the item. It's a verbal contract between you and the grocer to transfer certain goods and or certain goods for a consideration. There are certain contracts which are typically implied by certain business practices which are customary in nature. One of the critical element of a contract should be that all the parties to the contract have to be equally committed to perform their respective obligations over the duration of the contract. Certain times the duration of the contract is maybe fixed in nature, or it may not be specified in the contract, it may be implied based on the time required to perform or to satisfy a performance obligation. In that case, you have to apply the provisions of the standard over the duration of the contract. The next criteria talks about the rights of each party that can be identified. Now, there can be multiple arrangements with various people or maybe with a customer. Typically, the critical part of the arrangement is when any arrangement gives a rise to a valid right or obligation, right and obligation, say right of one party and obligation for another party in a contract which is enforceable, then it becomes a contract. It can be a matter of law that a contract will be enforceable, where the rights of the party or the obligations of the party will be enforceable. However, the critical component for the purpose of the standard is that in a contract, the rights of each party should be clearly identifiable. Third criteria is the payment terms. In the contract, the payment terms should be clearly identifiable. Fourth is the commercial substance. The commercial substance talks about the risks and reward under the contract primarily. That means the risks and rewards of the contract, what are the risks and what are the rewards of the contract should be clearly identifiable, should be clearly understood. Timing of the contract should be clearly understood. The amount of change in the entity's future cash flows should be evident. Commercial substance is where one party is actually performing an obligation or fulfilling a performance obligation, and another party is getting some asset or getting some goods or services transferred to them. That makes a change in the cash flow of either entity. The entity which is performing the obligation has to see an increase in their cash flow at some point of time, and the entity that is receiving the goods and services or the asset has to see a depletion in the cash flow through a payment at some point of time. That is the commercial substance. That has to be clearly demonstrated in the contract. And the last element is that the probability of collection of consideration should be sure. There should be a high probability or some probability of collecting the consideration from the customer. So the customer's ability and intention to pay the consideration when due has to be the critical factor that has to be taken into consideration. The customer you may have a contract with the customer. However, if the customer does not have the ability to pay, or the customer does not have the intention to pay, that brings a kind of a doubt whether this contract has a commercial substance, and the probability of collection of the consideration, whether the consideration will be collected at some point of time or not. A doubt arises. Next. What are the general considerations in identifying the contract, which is the step one? Agreement between two or more parties that give rise to enforceable rights and obligations thereunder, which is typically a matter of law. Enforceability becomes a matter of law of the territory or land or a country where the contract is being entered into. The form and nature of contract, as mentioned earlier, there can be written contracts, which are formal contracts, formal arrangements. There can be verbal contracts, implied contracts. These practices and these processes will vary across territories, countries, legal jurisdictions, and industries, depending on the practices in that respective territory or industry. A form and nature of a contract could vary entity-wise, can be different based on the nature of the product or service or class of customers as well. Some can be absolutely formally written, some can be verbal. There can be fixed period contracts. There can be contracts where no fixed period has been defined under a contract. The key principle to understand and to identify whether an arrangement indicates a contract based on all the relevant facts and circumstances and applying the requirements of the standard within the contractual period. That's a key principle. Understand all facts, understand the terms of the contract, understand the arrangement, and come to a conclusion whether the arrangement is actually indicating or demonstrating a contract. Next. Next, please. Next slide. There can be combinations of contracts. The rule given in the standard is 2 or more contracts can be combined, typically entered into the same time with the same customer if the contracts are negotiated as a package with one single commercial objective. Second, the amount of the consideration paid in one contract is dependent on the price or performance of the other contract. The goods or services promised in all the contracts are a single performance obligation, or some goods or services promised in each of the contracts are a single performance obligation. At times, a contract is negotiated as a complete package. So there are various distinct goods and services which are combined in a package with one single commercial objective of earning profits. At times, the amount of consideration paid in one contract is dependent on the price or performance of the other contract. Say if there is a contract for maintenance of a IT software system, the customer, the entity also has a contract entered into in implementing the software system or customization of that software system. Unless the customization or unless the installation of that software system is completed, you cannot start performance obligation of the second contract. At times, they are interdependent. The third is the goods or services promised in all the contracts could be a single performance obligation. Say there is a contract to supply a particular good. There is another contract to say use that good supplied to make create another asset. Say for example, the entity is supplying say certain construction material to the customer. The entity is also trying to construct a particular building or any particular construction for the customer. Maybe these two contracts are interdependent and they are a single performance they can be considered as a single performance obligation, although they are two different contracts because they are linked to each other. They can be considered as a single performance obligation. Next slide. Certain times contracts see a modification. Why can a contract undergo a modification? One thing, it can change in the scope, it can change in the price, it can see a change in the scope as well as change in the price. If you see a change in the scope or change in the price or change in scope and price, all unless and until it is the entire change is approved by all the parties to the contract, you may not call it an amendment. Contract will undergo an amendment as far as a change in the scope, change in the price, change in the scope as well as price, and if it is approved by all the parties to the contract, it will be called amendment in the contract or a change order or a contract modification. Approval of the parties to the contract, all the parties to the contract, is the critical most factor in establishing whether that modification is a modification to the contract or not. What happens when the contract is modified? That creates a change in the existing enforceable rights and obligations, or it creates a new set of rights and obligations for the parties. Next slide, please. Next slide. Let's look at the decision matrix. Contract modification. When does a contract modification become a separate contract? Does the contract modification results in a termination of the existing contract, or it's just a modification of the existing contract? Say you have a contract modification where the goods and services are distinct. The contract modification is for goods and services that are distinct from the goods and services transferred before the modification or from the original contract. And also you have a price that is given for the modification, which is actually indicative of the different selling price or the selling price in the market for those distinct goods and services. If you have a contract modification for distinct goods and services and you have a price that is a single sole selling price for those distinct goods and services, you can say that the contract is in the nature of a separate contract. You can modify that contract instead of changing the existing contract or terminating the existing contract. You can actually enter into separate contract. But given the situation, you have a modification in the contract where the goods or services are not distinctly identifiable. In that case, you may just modify the original contract. In case there is a situation where the goods are distinct, the goods or service under the modified arrangement are distinct. However, the prices that are decided under the modification are not the market prices or the sole selling prices for that particular good or service. In that case, you may terminate the existing contract and you may enter into a new contract. Next, please. Next slide. I think just the earlier slide. I think you'll have to go to the earlier slide. I will give examples of the modification of the contract. Just give me a minute.
Vajantimala.
Yeah, just give me a minute. Okay. See, you have a contract to supply a quantity of certain widgets, a number of widgets, say for 10 rupee per widget. After a certain time, you enter into a modified arrangement to supply additional 100 widgets, however, at a lesser price, which is say 8 rupees per widget. Now, how will you treat this contract? Whether you will treat this contract as a modification of the existing contract, you will treat this as a termination of the contract, or you will enter into a separate contract, and or you will create this as a separate contract. The market price of the widget is say rupee 10, And the earlier contract says you have to supply 1000 items at ₹10 per item. You added a component of another widget 100 at say 8 rupees. Now here in the market price of the widget is 10, however you are entering a modification at 8. That indicates that it's not the actual price of the widget, that is the market price. So you will not consider that as a separate contract, because maybe it's a distinct good or service, yes, but the other criteria, the sole selling price of that particular distinct good or service is not satisfied. So in this case, what will you do? You will actually terminate the existing contract and you will enter into a new contract saying that my original 1000 quantity plus 100 quantity at a total price, whatever it is. Yeah, that's the way you will make a modification in the contract. Let's go to the next slide. Coming to the step 2, which is identifying performance obligations. The key principle over here is you have to identify performance obligations at the contract inception itself. And you have to understand what is a performance obligation under a contract. Performance obligation under a contract is a promise to transfer to the customer either a good or a service or a bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same in nature and that have the same pattern of transfer to the customer. The next slide will explain it much better. Go to the next slide. So what is a promise? The promise is to transfer goods or services to the customer under a contract. Promises are implied through customary business practices or entities' policies. Together, the promises build expectations of a customer that a particular performance obligation will be fulfilled over a period of time. Activities that the entity undertakes to fulfill a contract, unless that indicates or that directly relates to a transfer of goods or services, are not part of the promise or performance obligation, such as say certain administrative activities. Those are not those are not part of performance obligations because those are actually not resulting in the transfer of goods and service to the customer. Now, another thing is, what are distinct goods or services? There are two criteria to be met when we talk about distinct goods or services. First criteria, the customer can benefit from the good or service either on its own or with other resources that are readily available. For example, you have purchased a LED TV. That's it. Why is it a distinct good or service? You can install it and you can start to use it. How can you start to use it? You have to have an electricity connection. You have to have internet connections or all the connections that you need to start the LED TV. If you have readily electricity connection, you can immediately start using that asset. That's a distinct good and service. The second criteria that has to be fulfilled under contract is the entity's promise to transfer the goods or services to the customer is separately identifiable from the other promises in the contract. So to actually purchase or to transfer that LED TV to a customer should be separately identifiable from the, if there are other components of the contract, say extended warranties or maybe some freebie items or maybe certain credits or some coupons or something, it should be separately identifiable under the contract. That makes it a distinct good or service. Next slide, please. Next slide. So separately identifiable promise, one sec, just the slide before that, slide number 17. Separately identifiability of a promise. We just talked about that the promise or the performance obligation has to be separately identifiable. What are the indicators to understand that these are separately identifiable? The entity does not bundle one or more good or service, resulting in a combined output to be transferred to the customer under the contract. Say, for example, the entity has to create a particular asset for which inputs are required. If inputs are required, that input cannot be a separate obligation. That input cannot be a separate promise because it cannot be identified as a distinct good or service, because the combined output has to be transferred to the customer, and that's the reason you cannot separately identify that promise, and that's the reason it doesn't become a separately identifiable performance obligation. The second is the good or service does not significantly modify another good or service promised in the contract. Say, for example, an entity is actually into catering services and they are supplying food or maybe breakfast or lunch packages to corporates. Any item, any input given in the making of that lunch item or the breakfast item or the dinner item, snack item, cannot be a separate performance obligation, because it is getting into making that particular asset or the product, and it is not separately identifiable. It does modify another good or service, maybe another input in the whole process, and thus it cannot be identified. Supplying of a input itself for making of the item cannot be identified as a separate performance obligation. The good or service is not highly dependent or highly interrelated with other goods or services promised in the contract. It has to be separately identifiable, it has to be separately seeable, demonstrable. If the promised goods or services are not distinct, they should be combined with other goods or services until a distinct bundle of goods or services can be identified. Say, for example, an entity is into construction of projects, of construction of buildings, and they are also into supplying of material for the construction purpose. Now, just supplying certain material to construction may not be identifiable as a separate performance obligation if the whole contract with the customer is to create a particular building or a particular structure. So that is what it says, that if the promised good or service are not distinct, and they should be combined with other goods or services until a distinct bundle of goods or services can be identified. Say a building can be identified. Next. Next, slide number 18. Yeah, these are some of the examples of a distinct good or service. Say sale of manufactured goods or traded goods. Say sale or resale of rights to goods or services. Performance of an agreed upon task for a customer. Provision of service of standing ready to provide certain goods or services. Provision of agent services. Say arranging for another party to transfer goods or services to the customer. Grant of rights to goods or services to be provided in the future to customer to enable him to resell those goods and services to their own customers or his own customer. Say developing or constructing an asset for the customer. Grant of certain licenses. Grant of options to purchase additional goods or services. These are examples of distinct goods or services given under, very clearly given in the standards. Next slide. Now, after actually identifying the performance obligation, we come to the next step, that is determining the transaction price. Now, key assumption in determining the transaction price is that the goods and services will be transferred to the customer as promised under the contract. This is the key assumption. Another key assumption is that the contract will not be terminated, renewed, or modified. Unless this key assumption is present, you cannot go and identify a transaction price. If you anticipate the contract to be terminated or contract to be modified or maybe contract to be renewed at some point of time, you cannot determine the transaction price because there are unknown variables, there are uncertain conditions. You don't know how would you determine a transaction price. one of the critical condition or one of the critical component in a transaction price is a variable consideration. Variable consideration can be a part of the contract which is not fixed, which is not certain at that point of time. Variable is uncertain, maybe depending on the conditions in future, depending on events that are expected to occur in the future, and that's the reason they are variable and not determined at this point of time when you enter into a contract. So they may be part of the contract or they may not be a part of the contract. Amount of consideration may vary due to elements such as discounts or rebates or price concessions, refunds, credits, performance rewards, incentives, or penalties, performance penalties. Penalties specified in the contract could form part of a variable consideration as they are inherent in the determination of the transaction price. One example, very critical example of this is, consider BPO services. BPO services are, say, call center services or maybe shared center services. In that case, a set of people, employees of the entity, are performing certain set of services for a customer, say a telecom customer like a Vodafone or a Airtel or maybe any other customer, Jio. When a contract with the customer is entered into, they specify certain performance criteria, that you need to have a call ended, a customer call ended within 1 minute or 30 seconds or 75 seconds or whatever. Those performance conditions are chalked out very clearly in the contract. If you do not meet those performance conditions, there are penalties specified. Those penalties are very specifically written in the contract, given in the contract, and at end of a period which is defined in the contract, they are actually calculated and they are actually considered as a part of the transaction price. That's what the penalty specification in the contract. Entity's entitlement to consideration depending upon occurrence or non-occurrence of a future event. For example, if an entity is, say, in selling some bulk products like, say, polypropylene or some product which is a key ingredient in many industries, many consumer goods industries, say Reliance is a very big supplier of polypropylene. Reliance has a typical process or a typical custom through which their regular customer, they actually commit a particular quantity turnover with Reliance. So say 1,50,000 tons or maybe 2 lakh tons. If that quantity has to be achieved over a period of time, maybe mostly 1 year or 6 months, and if that quantity target is achieved by a customer, then a discount in the price is given or a rebate in the price is given by the entity, and that is not certain at the time of entering into a contract. That will actually be determined only after the particular period is over and whether the customer has lifted that much targeted quantity or not. So it is dependent on the occurrence or non-occurrence of an event that is in future. Next slide, please. Next slide. Yeah, no, slide number 21. Right. The variability related to the consideration exists. How do you actually analyze the variability? How do you understand whether variability actually is existing in the contract? As per the customary business practices or precedents or entities' policies or practices or procedures, customer has an expectation that the entity will accept an amount of consideration lesser than the price stated in the contract. That means variability exists. Other factors that indicate that an entity will offer a price concession to the customer at the time of entering into a contract, which is the intention demonstrated by the entity through negotiations, then there is an element of variability that exists in the contract. Now, estimation of amount of variable considerations, there are two methods given. Variability, it will probably not be you will not be able to actually calculate the variable consideration at the inception of the contract, and that's the reason it becomes variable. How do you actually understand and measure the variability? One is the expected value method, and the other is the most likely outcome amount method. Expected value method is a very regular method used in various analysis or various analysis and this thing in the industry. It is basically nothing else but determine the basic ranges of possible outcomes, measure them based on the probability weighted amounts for the range of outcomes, and determine how much is the variability, measure how much is the variable compensation or a consideration. This is mostly used in cases of large number of contracts with similar characteristics. You may have a process or you may have a procedure to actually use this method or utilize this method to determine the variability in the transaction price. Another method is the most likely amount method. This is mostly judgmental. A significant amount of judgment is involved in this. This is nothing else but single most likely amount in the range of possible outcomes or a possible consideration amounts. So it's based on a judgment, based on a precedence. The entity will pick up one single most amount that entity feels it is likely. That could be the variable consideration, measurement, the entity. Whatever it is, the key principle here is whatever method you choose to apply, you please choose it consistently throughout the contract. Consider all the information that is available at that point of time to the entity, identify reasonable number of possible consideration outcomes so that you are, close to the reality. The next slide, please. There are two more concepts introduced by the standard in the step 3, which is determining the transaction price: refund liability and constraining estimates of variable consideration. Now, what is refund liability? Refund liability is something that entity receives a consideration from the customer. However, the customer expects a refund of some portion of it or all of it at some point of time. That is the refund liability. And how do you demonstrate a refund liability? How do you estimate a refund liability? Refund liabilities are typically measured at the amount of consideration received from the customer, but which the entity does not expect to be entitled to. And maybe the amounts are not included in the transaction price. You've received some amount of money from the customer, which is not a part of the transaction price as per the contract. At some point of time, the customer may want a refund of it. That is the refund liability. Another refund liability, typically how it should be measured is it should be revised, revisited, and updated at the end of each reporting period, because refund liability at that point of time, at the inception of contract, may undergo changes as per the circumstances change, or as per the customer expectations change, or maybe as per any other contract considerations change. That's the reason at each reporting period, the refund liability has to be revisited by the entity and updated at the end of each reporting period, maybe based on the conditions existing at that point of time. Now, there are some constraints for the estimates of variable consideration, and let's see what are those constraints given by the standard. Say, they include variable consideration in the transaction price only to the extent it is highly probable that the cumulative revenue recognized will not be reversed when the uncertainty associated with the variable consideration is resolved. Say, likelihood and magnitude of the revenue reversal is the main consideration over here. Constraining estimates of variable consideration. Basically, when you estimate a variable consideration, when you measure the variable consideration, two factors are utmost of priority for consideration: that the variable consideration in the transaction price should be measured and recognized only to the extent that it is highly probable that the cumulative revenue recognized under the contract will not be reversed. In case there is a probability that cumulative revenue already recognized under the contract may be reversed when the conditions for variable consideration become clear. In that case, you will not measure the consideration. You probably may not recognize the variable consideration if you feel that the revenue could be reversed at a later point of time. And the second is the likelihood or magnitude of the revenue reversal is the main consideration. If the magnitude of the revenue reversal is not that much, it is not material, and the likelihood of the revenue reversal is also not high, then you may not look at, then your variable consideration measurement is not constrained, is what the standard is trying to say. What are the factors to consider? High susceptibility of the factors outside of the entity's control. The events that we are waiting for to happen to crystallize the variable consideration or to make the variable consideration final are not in the control of the entity. They are outside of the control of the entity. They are broadly dependent on the economic situation, maybe the industry, the competition, or maybe interest rates, or maybe the government policies, which are not in control of the entity. That makes it little uncertain, and uncertainty not expected to be resolved for a long time. So this uncertainty, for example, there is any consideration that is dependent on the current situation, which is COVID-19 situation. We don't know at this point of time at what point of time this situation is going to resolve and the normalcy is going to regain. So if it is for a long period of time uncertain events, that is a critical factor to consider in actually measuring the variable consideration. Also, limited experience of the entity in the type of contract that they have entered into. The entity may have started a new line of business and it's a new contract. It's the first few contracts with the customer. Entity does not have any precedence. In that case, you cannot measure the variable consideration with certainty. You may have a lot of uncertain matters, uncertain facts, which will restrict you to measure the variable consideration. Again, the principle of the standard says at each end of the reporting period, entity is required to update the estimated transaction price, including variable consideration, based on change in the circumstances during the reporting period. Next slide, please. There is one significant factor in determining the transaction price is a significant financing component in the contract. A lot of times what happens is that the entity fulfills its performance obligations under a contract. However, the timing of the customer payments differ contract to contract. The timing of the customer payments, maybe the customer is paying upfront, or the customer is taking a long credit period and customer is making a payment, or customer is making staggered payments. Maybe the payments are coming in tranches. Maybe for a large projects or large contracts, it can happen. The timing of the payment by the customer in exchange for the transfer of goods and or services give rise to a financing component in a contract. So if you have actually performed obligation at a later point of time, however, the customer has made a payment much earlier to you. What does that mean? You have not fulfilled the performance obligation, but customer has made a payment. That could give rise to a financing element in the contract. What does the standard require? In case there is any financing element in the contract, the standard requires an entity to adjust the amount of consideration for the effects of the time value of money while determining the transaction price. So at the inception of the contract, based on the structure of the contract and the way the customer payments are scheduled, if you find any financing element in the contract, what needs to happen is your transaction price has to undergo a modification or adjustment. This will have to be done in cases where the timing of the payment agreed by the party actually facilitates financing the transfer of goods or services to the customer. Like I said, that the customer is making significant amount of advance payments. That means typically, is the customer funding the transfer of goods and services to themselves? Maybe that could be the case. Maybe the customer is doing that. Maybe if the customer is actually delaying the payments, the customer is actually delaying payments beyond 1 year, staggered payments. Does it mean that we are financing, the entity is financing the entire transfer of the goods and services to the customer even after the customer has got the control of the asset? So those are the financing elements which you need to determine in the contract and accordingly adjust the transaction price. The objective, the significant financing component exists in the contract, may be explicitly or implicitly through the pattern of the customer payments. Now, the objective of the standard in adjusting the significant financing component is for the entity to recognize revenue at amount that reflects the cash selling price. So if the entity has to fulfill a particular performance obligation under a contract through a transfer of asset to a customer, say today, if that had to happen today without having a contract, what would have been the selling price? What would have been the price that the customer would have paid to the entity? That is actually market price. That is the price that should be reflecting in the actual transaction price. That is the reason a financing component has to be segregated and the transaction price has to be adjusted. That's the intention of the contract, the standard. What it says is that the objective is to adjust the significant financing component for the entity to recognize revenue at the amount that reflects the cash selling price that the customer would pay in exchange for transfer of those goods and services under the contract. Now, whenever customer is making upfront payment or payment ahead of the performance obligation getting fulfilled, maybe it's a funding to us, they are funding the transfer of goods or services to them. If they are staggering the payments, if they are delaying the payments, we are financing. So it depends on who's financing and what is the finance component. The entity need not adjust the consideration for the effects of significant financing component at contract inception. The entity expects to receive the payment from the customer in exchange for transfer of goods and services within 1 year or lesser time. So the standard is very specific over here and very clear over here. In case the customer is making a payment to you for the transfer of goods and services to them, which is a performance obligation fulfillment, within 1 year's time, you may not have a financing component in the contract. It's very simple and clear. If it extends beyond 1 year, then only entity needs to look at if there is a financing component. This is considered to be the practical expedient in the standard given for applying this particular requirement. Next slide, please. Next slide. Yeah. There are couple of other considerations as far as the determination of the transaction price is concerned. That non-cash consideration. Transaction price in case of contracts that have consideration in the form of other than cash, that also has to be recognized as a transaction price. However, that will be measured at the fair value as per the requirement of the standard. If fair value of a non-cash consideration cannot be estimated, a lot of times it's very difficult to estimate the fair value of a non-cash consideration. Maybe because there are no observable inputs available at that point of time. The consideration then should be measured based on and by reference to the standalone selling price of the goods or services promised under the contract. So if you have a non-cash component in the contract, and if you are not able to figure out what's the fair value of the consideration, one way to look at it is to look at the selling prices, the market prices of those goods or services which are prevailing in the market, standalone selling prices which are prevailing in the market and estimate the consideration, the transaction price. It may vary based on the form of consideration. The fair value of a non-cash consideration can vary based on the form of the consideration. In case the fair value of the non-cash consideration varies on the basis other than the form of the consideration, the entity is required to estimate the same as the basis given in the standard. So the basis given in the standard, there are methods of estimating fair values. We all know there are multiple methods of estimating a fair value based on the measurable or observable inputs, and some are non-observable, in which case you have methods available of estimation of the fair values, which are actual valuation principles. Those are, couple of them are given in the standard, and in case, you know, the fair value cannot be estimated or the non-cash component is depending on the basis other than the form of the consideration, then in that case you have to go back to the standard and apply the provisions of the standard. In case a customer is contributing to the goods or services, for example, the customer is supplying material, customer is supplying labor, or customer is supplying equipment to a particular fulfillment of a performance obligation by the entity to facilitate the fulfillment of the contract, and if the entity obtains the control of those goods or services, the entity should consider them as a non-cash consideration received from the customer. Say, for example, the entity has received some kind of equipment in a particular project to fulfill the performance obligation. Say, for example, the entity is in manufacturing of, say, certain beverage, and to manufacture certain beverage, to pack those certain beverage, the customer has provided you an equipment, which is a packing equipment. If the equipment, the customer, the entity takes a control of that equipment in the fulfillment of the performance obligation, which is supplying of the pack the beverages and supply the beverages to the customer, that the fair value of that equipment will be considered as a non-cash consideration received from the customer, because the reason is the entity has taken control of that equipment or that input, say material, labor, or equipment, or any other input. Next slide, please. Next slide. Yeah, no, the earlier one. Earlier one. Slide number 25. Yeah. Slide number 25. 25. 25. Yeah. There is another topic that is the standard has discussed, which is consideration payable to the customer. Now we all would wonder that in a contract with customers, which is typical revenue for us, and we need to receive, as the entity needs to receive the consideration, which is the transaction price, why would a consideration be payable to a customer? The consideration could be payable to a customer maybe for various reasons. For items that can be applied against amounts owed to the entity, cash amounts the entity pays or expects to pay to the customer or to other parties that purchase the entity's goods and or services from the customer. So you have a customer to whom you are supplying certain goods or you are providing certain services. That customer is further selling those goods or supplying those services to their customers. You may have certain payable to the customer regarding that can become a consideration payable to the customer. Consideration payable to the customer is accounted for as a reduction in the transaction price and resultant revenue, unless the said payment to the customer is in exchange for distinct goods or services the customer transfers to the entity. Again, I'll repeat this. This is a little complicated. Consideration payable to the customer is accounted for as a reduction of the transaction price and the resultant revenue, unless the said payment to the customer is in exchange for distinct goods or services the customer transferred to the entity. So you have a contract with the customer. However, outside of the contract or maybe within the contract, the customer also has a performance obligation to supply certain goods or services to you. If that is the case, you may not reduce your transaction price because they represent distinct goods or services. However, if that is not the case, then it will be adjusted. The consideration payable to the customer will be adjusted as a reduction of the transaction price and the resultant revenue. In case consideration payable to the customer is on account of distinct goods or services from the customer to the entity, then the transaction should be recorded as other purchase transaction. Say you are selling some certain goods to the customer. In turn, the customer is selling certain goods to you, or customer is providing certain distinct service to you. They may not form part of the same contract. That could be a completely separate transaction as well. Like, given the initial example, say you are a beverage manufacturing company and you are selling certain beverage to a customer. The customer is in the business of selling the beverages, also maybe providing certain other service too. And if the customer is providing that service to the entity, they may be two complete different transactions, and that could be accounted for as a separate purchase of goods or separate purchase of a service. That will not form part of this particular contract with the customer. If the amount of consideration exceeds the fair value of the distinct goods or services the entity receives from the customer, the excess should be accounted for as a reduction of the transaction price. If the amount of consideration that you receive from the customer in exchange for the distinct goods or services the entity receives from the customer, the excess should be accounted for as reduction of the transaction price. Now here it says that you need to estimate the fair value of the consideration of the distinct goods and services, and in case the consideration under the promised under the contract exceeds the fair value, in that case you should account for that as a reduction in the transaction price. In case the fair value of distinct goods or services cannot be estimated reasonably, the entire consideration received from the customer should be recorded as a reduction of the transaction price. The fair value of the distinct goods or services are not estimated with reasonable certainty. In that case, the entire consideration received from the customer should be recorded as a reduction of the transaction price. What it means to say is that consideration payable to the customer, you cannot estimate the fair value of the goods or services, distinct goods or services that the customer maybe has given to you. In that case, what needs to happen is that you need to account for that consideration payable to the customer as a reduction from the consideration that the customer pays to you towards the transfer of goods or services under the contract as a reduction of the transaction price. Next slide. The step 4, after identifying a contract, identifying the performance obligations, identifying the transaction price, measuring the transaction price. Now the fourth step that the standard tells us is to allocate the transaction price to the performance obligations. The core principles, the allocation principles and the allocation objective over here is the allocation of transaction price to performance obligations should represent or depict the amount of consideration the entity expects to receive in exchange for transfer of promised goods or services to the customer under the contract. I think at the start of the discussion, we had said this is the core principle of this accounting standard 115, that what is a transaction price, and transaction price is nothing else but the entity expects to be entitled to certain consideration in exchange for the goods or services. That is what is the core principle in allocating the transaction price to the performance obligation as well. If the contract has only one performance obligation, there is no problem. There is no criteria to be adopted. It's very simple. One performance obligation, transaction price under the contract is allocated to that performance obligation. Except where one performance obligation comprises transfer of a series of goods or services that are distinct in nature, and the consideration includes the variable amounts. So two scenarios over here. One performance obligation, however, that performance obligation comprises multiple distinct goods or services which are multiple and distinct in nature. And the second is the consideration includes variability element. In that case, the allocation principles given in the standard will have to be applicable. Key allocation criteria is relative standalone selling price basis. That's the key allocation criteria. Relative standalone selling price basis. If you take a distinct good or service and you actually go and see if at any point of time that distinct good and service will fetch what kind of price in the market, that market price is nothing else but the relative standalone selling price of that particular distinct good or service. And the only criteria or the key criteria, allocation criteria under the standard to allocate a transaction price to the performance obligation is that you need to demonstrate while allocation that the relative standalone selling prices to be determined at contract inception for the distinct goods or services underlying each performance obligation in the contract with the customer. Allocate the transaction price in the proportion of the standalone selling prices of the distinct goods or services. Next slide, please. Next slide, 27. Allocation criteria continued. Standalone selling price is the price at which the promised good or service is sold to a customer separately in the market. Examples of observable standalone prices, selling prices, and selling prices of a good or service the entity sells to similar customer in similar circumstances. There are certain prices that are observable, like it's a unique or a homogeneous or a standardized product that you are selling to a customer. The price may be observable in the market, which is the selling price of that particular good or service in the market. List price of a good or service with the entity. The entity may have list prices of goods or services. A price for a good or service stated or agreed under a contract with a customer can be an indicator of a standalone selling price. Say you have similar contracts with entity has similar contracts with multiple customers to give a similar, sell a similar good or provide a similar service. So what the prices that are actually agreed upon in the contract can be an indicator of a standalone selling price of that good or a service under a contract. It should not be presumed that unless the evidence suggests otherwise. So this is just an indicator. You cannot assume that if there is a particular price stated in the contract with a customer, with a particular customer, at some point of time, that becomes a standalone selling price. It's just an indicator. Standalone selling price at times is not observable. In that case, the entity has to estimate it at an amount that would ensure the core principle of meeting the allocation objective given in the standard, depicting the consideration expected by the entity. Again, you have to go back to the core principle, the consideration that the entity expects to be entitled to at any point of time for transfer of that particular good or service. After duly considering the relevant information available about the transaction, market conditions, maximum use of the observable inputs. If
Hello?
this, hello?
Hello? Ma'am,
Yeah.
5 to 10.
Yeah. So last, we come to the, after this, we come to the last step. Yeah. Go to the next slide. Next slide. Yeah. There are certain considerations in the assessment of adjusting the significant, go to the next slide. Next slide.
Slide number.
Next slide. Next slide. Next slide. 30. Right. Methods of, yeah. Just go to the 30 number slide. Number slide. Slide number 30. Slide number 30.
38. 30.
Yeah. So methods to estimate standalone selling prices, which is adjusted market assessment and expected cost plus margin method. These are given by the standard. Adjusted market assessment method is market in which the entity sells the goods and services, and the price that the customers are willing to pay in that market becomes the adjusted market assessment based price. There is another price that you can estimate through expected cost plus margin. If the entity is expected to incur certain cost, and whatever is the reasonable margin the entity expects, that becomes the expected cost plus margin basis. There is another approach called a residual approach. The residual approach says you estimate that you see the total transaction price less the sum of all observable standalone selling prices of other goods or services which are distinct in nature, and the remaining price, the remaining remaining transaction price will be your uh, allocation price for that particular performance obligation. So if you do not have a standalone selling price available in the market, it is not observable, you cannot estimate it with certainty, what will happen is that you can take the residual approach. You will say that what are the other distinct goods or services in the contract, what are those standalone selling prices, if they have their standalone selling prices, minus the total consideration will be the remaining consideration amount of consideration which will be allocated to the performance obligation, where you cannot estimate the actual standalone selling price. Yeah, just go to the next slide. Next slide, 31. Next slide. Yeah, next slide. Okay. Just go to the earlier slide. I'll just pick it up in a minute. Earlier slide, 31 slide. 31. Right. A combination of methods are allowed by the standard, and you can use the method which is suitable to your circumstances, as in the entity circumstances. Now, the discounts, and this is a critical component in a contract with a customer. Some of the standalone selling prices of promised goods and services exceeds the promised consideration. As per the contract with the customer, a discount arises. So the standalone selling prices of all the distinct goods and services taken together, and the transaction price as per the contract, if you see the difference of it, if the transaction price is lesser, that means that the entity is giving a discount to the customer. Now, discounts are allocated to the performance obligations in the proportion of their respective transaction prices, which is allocated based on their respective standalone selling prices. We go back to the same principle again and again, which you need to completely keep in your mind, unless there is an observable evidence that the entire discount relates to maybe one or more performance obligations. Next slide. Next slide. Yeah. There are multiple conditions given in the standard for discount allocation, which I'm not going through in detail. Next. Yeah. Allocation of variable consideration, I think we have discussed, but I'll just reiterate. The entity can allocate variable consideration to one performance obligation or to only few performance obligation but not to all, given when the single performance obligation by fulfilling two criteria. The terms of the variable payment specifically relate to the entity's efforts to satisfy maybe a single performance obligation or only few performance obligation, or transfer of distinct goods or services, or to a specific outcome of satisfying the performance obligation. So if you know, you have evidence and you have completely demonstrable facts that the variable consideration can be allocated to one or maybe specific performance obligations, or in relation to the transfer of goods or services under that performance obligation, you may allocate it specifically. The allocation of variable consideration entirely to the performance obligation to distinct goods or services is consistent with the allocation objective. The allocation objective again is the same. It has to demonstrate the uh, the consideration that the entity expects to be entitled to. If that the allocation principle of the variable consideration actually meets that criteria, then you can allocate it to single performance obligation. The remaining amount of transaction price is to be allocated as per the requirements of the standard. Next slide. I'll just take it in a couple of seconds. Changes in the transaction price can happen based on changes in the circumstances or resolution of certain uncertainty leading to changes in this amount of consideration. Allocation basis will be same as at the contract inception. Subsequent changes to the transaction price for performance obligations that are satisfied to be recorded at the revenue or reduction in revenue as the case may be. And allocation of changes to the transaction price to one or more performance obligation but not to all, adoption of the same basis that we discussed, which reflects the core principle.
May I just I just wanted to know how much time will take more, because the session has been planned for,
so I'll take 10 minutes more because the last step is now pending.
Sure. So we planned it till 5:30, and otherwise the session will get timed out. That is the whole thing.
So it is already 5:36. My suggestion is that you extend for next 10 minutes.
Sure.
Yeah, because we are at the fag end of the standard. Now go to step number 5. Go to the next slide. Next slide, please. Yeah, next slide. Yeah, now this is the most critical and the last stage in the Ind AS 115, which is recognized revenue. The first principle to remember here is when a performance obligation is satisfied, the entity is entitled to recognize revenue. Now I'm going to take 10 minutes here because it's a critical most phase of the standard. Revenue should be recognized when the entity satisfies a performance obligation by transferring goods or services referred to as an asset under a contract to a customer. An asset is transferred when the customer takes control of that asset. Now, what I want to reiterate, or what I want to say here, is that if you look at the erstwhile standards, the entire focus was on transference of risks and reward of related to the good or service to the customer from the seller. That was the key principle in AS 9 also, and other Ind AS 18 primarily. However, Ind AS 115 is different, where it emphasizes transfer of a control rather than transfer of risk and reward. Transfer of risks and reward related to the distinct goods or services under a contract is just one of the components of a control, transfer of control, which will come in the subsequent slides. Now, control, what is a control? Control of an asset refers to an ability to direct the use of and obtain substantially all of the remaining benefits of an asset. So if anybody has taken control of a particular asset, what can that person or that entity do? The person can actually use the asset, is able to use the asset, or the person is able to obtain all the benefits out of that asset by reselling the asset somewhere, or by maybe utilizing in any other manner, or maybe in any other production process or whatever. That is the key over here in the standard. Yeah, control also includes the ability to prevent other entities from directing the use of or obtaining the benefits of the said asset. So not only control not only demonstrates that the entity who has the control can take the advantage of the asset, but the entity also can restrict other entities from taking the advantage or taking the benefit under that of that asset under the contract. Benefits arising out of the asset are potential cash flows received or to be received or expected from the use of the asset. So when an entity uses the asset, what does the entity do? The entity expects to earn certain cash flows from the use of the asset, like a fixed asset, a machine or something. If the entity is taking a control, or a customer is taking a control of that machine, means that the customer can sell that machine on to somebody else and get cash flows, or use the machine in their own production process, and through the sale of the end product can earn cash flows. Cash flows can be obtained directly as well as indirectly. Next slide, please. Okay, what is deriving cash flows from use of the asset? Basically, to produce goods or produce services, to enhance the value of the asset. So through enhancement in the value of the asset, you can also earn by reselling the asset. You can earn consideration, you can earn cash flows, and that's the way you can derive cash flows. To settle liabilities or reduce expenses, you sell and use the asset in the production process, sell the end product, and you can from that cash flow you can settle the liability or reduce expenses. Selling the asset or exchanging the asset for consideration, pledging the asset as a security against a loan, and holding the asset. So basically, deriving cash flows would also mean all these things which are typical to any business. Yeah, at the time of evaluating whether the customer has obtained control of the asset, the entity should consider existence of agreement to repurchase the asset as well. There are certain times agreements entered into by the entity with the customer to repurchase the asset at some point of time. In that case, you may need to look at whether the control has been passed on or not. Next slide, please. Next slide. Okay. Core principle of control you have to remember is the ability of the entity or the customer or any party to direct the use of and obtain substantially all the benefits of the asset, or to restrict the access of other entities to those benefits. That's the core principle of control. Next slide, please. Yeah. Now, how do you satisfy? How does the entity satisfy performance obligation? There are two ways to satisfy a performance obligation. Performance obligation, lot of times, is satisfied over time, and performance obligation is satisfied at a point in time. Now, you say somebody purchases, say, a consumer good item, and you receive a consignment of that. You receive the delivery. That's a point in time. However, some entities constructing a building, constructing some asset, or constructing a full factory for a customer, that is satisfying the performance obligation over a period of time. Entity transfers control of goods or services over a period of time and satisfies performance obligation and recognizes revenue over time. That is satisfying over time. And satisfied at a point in time is if the performance obligation is not satisfied over a period of time, it is necessarily satisfied at a point in time. There are only two ways about it. There is no third way. Next slide, please. Performance obligations satisfied over a time. What are the criteria that have to be fulfilled? Either of the following. Customer simultaneously receives and consumes the benefits as the entity performs. What's the classic example of this? Somebody is implementing, some IT company is implementing or actually implementing a software for a customer. So there are various modules in a software, say SAP kind of software, PeopleSoft kind of software. So 3-4 modules have already been implemented. The customer actually can start to use those modules which are already implemented by the IT system while they implement the other modules in the IT software. The entity's performance creates and enhances the asset that the customer controls as it gets created or enhanced. Say there are certain software, again I take the same example, certain software, say earlier version. Now the IT company, the entity is actually enhancing it, customizing it, and making it better, expanding, or maybe enhancing the speed or enhancing the capacity or adding modules to it. That is enhancement of the asset, and the entity can actually make use of it. The entity's performance does not create an asset that has an alternative use to the entity. So entity is constructing a project, entity is constructing a factory, but the entity is constructing it for the customer, not for themselves. If it is creating some kind of advantage or alternative use for themselves, that may not be a case of performance obligation satisfied over time. In that case, you may wonder whether a performance obligation has been fulfilled or not. There are exceptions to this. For example, you have given an order for some particular, maybe some snacks or something, bulk, maybe cakes or pastries or snacks. Maybe they are to be delivered to a customer in bulk. However, they can be replaced. So you pass on that particular prepared item to some other customer, or you consumed it yourself. You can always have some other item, similar item, prepared for the customer and delivered it again. So there are exceptions, but the basic principle is that the entity should not have any alternative use of the asset that it is constructing for the customer. The entity has an enforceable right to payment or performance completed till date. It's not necessary that the entity will receive a payment, but the entity has to have some kind of implied right to receive the payment for the work that has been performed or the obligation that has been fulfilled so far, in case the contract is terminated by the customer or maybe by both the parties at some point of time. That will reflect that the performance obligation has been satisfied over time. Next slide. Next slide. Right. Now key considerations. One sec. 41. Slide 41. Slide 41. Yeah. Key considerations. Contractually, entity may be restricted to use the asset created by itself for the customer. Entity may not have any use, or entity may be restricted by a contract itself from directing the same for another use during the creation. The assessment whether the entity has an alternative use of the asset or not has to be done at the contract inception stage itself, after which the entity is not allowed to reassess or not update the assessment unless a modification to the contract is approved by all the parties. Terms of the contract and applicable laws that apply to the contract are analyzed to assess whether the entity has an enforceable right to payment for performance completed till date. And right to payment for performance till date need not be for a fixed amount. It can be, the key over here is that the entity is entitled to that amount that compensates the entity for performance completed till date in case the contract is terminated by any party for reasons other than the entity's performance failure. Next slide. These are some of the things that have to be considered when you arrive at a decision whether the performance obligation is satisfied over time. Next slide. Next slide, please. Yeah. Now, performance obligation satisfied at a point in time. It is satisfied at a point in time if it is not satisfied over a period of time. The point in time at which the performance obligation is satisfied is the time at which the customer actually obtains the control of the asset. And what are the indicators of transfer of that control to the customer? Entity has a present right to payment for the asset, means that the control has passed on to the customer. The customer has a legal title to the asset. In case the entity regains legal title to the asset as a protection from customers' inability to make a payment, this right of the entity does not preclude the customer from obtaining the control. This is just one of the ways of protecting the entity from the credit risk. But customer has the legal title, the entity has transferred physical possession of the asset to the customer has the significant risks and rewards of ownership of the asset, and customer has accepted the asset. Acceptance of a customer in many cases is implied, not in every case it is given in writing or expressed by the customer, but it is mostly implied. If all the conditions in the contract are satisfied by the entity through fulfilling of performance obligation, it is implied that the customer has accepted the asset. Next slide, please. Next slide. Yeah. Now, how do you recognize revenue? You recognize revenue through measuring the progress towards the complete satisfaction of a performance obligation. Recognize the revenue over time by measuring progress towards complete satisfaction of the performance obligation, where progress is measured to demonstrate the entity's performance toward transferring of goods or services. How do you measure? Measurement is always towards transferring the good or service to a customer. That is the core principle. Revenue to be recognized only if the entity can reasonably measure the progress towards the completion. If the entity cannot measure the progress towards completion, entity cannot recognize revenue. In case progress cannot be measured, however, cost incurred to fulfill the performance obligation are expected to be recovered, the entity can recognize revenue to that extent. Entity to apply single method of measuring progress for each performance obligation satisfied over time, and should use the same consistently whatever method they use in similar circumstances and cases. Any good or service for which the entity does not transfer control to a customer should not be included in the process of measuring progress, and revenue should not be recognized. Each reporting period, the entity is required to remeasure the progress towards complete satisfaction of the performance obligation, and the measure of progress should be updated in case circumstances change over time. Next slide. When this is the last slide, just go to the earlier slide, 44 number slide. The core principle in recognition of revenue is when the performance obligation is satisfied, the entity should recognize revenue. What is the amount of revenue to be recognized? Is the amount of transaction price that excludes estimates of variable consideration, if there is any, and the transaction price that is allocated to the performance obligation. Go to the next slide. We'll just touch upon for a minute on the contract costs, and we'll end the session. Next slide, please. There are two types of contract costs. One are incremental cost of obtaining a contract and cost to fulfill the contract. The core principle over here is any cost related to a contract, if it is recoverable, clearly recoverable, you record an asset. If not, you should expense it out. That's the core principle over here. Incremental cost of obtaining a contract could be administrative cost that the entity incurs to obtain a contract, like a commission or a brokerage or something. That should be expensed out because typically those will not be recovered. And cost to fulfill the contract will be recorded as an asset, because if you expect to recover these costs, these will be recorded as an asset. Next slide. Next slide. Next slide. Amortization and impairment of the costs recorded as asset. The asset recognized to be amortized on a systematic basis based on the pattern of transfer of goods and services to the customer. That's a core principle. Whenever the entity has an indication or the facts and circumstances saying that this is not recoverable, you will impair that particular asset. That's the core principle. And the impairment loss will be recognized to the extent of carrying amount of that asset recognized, In case that asset exceeds the consideration receivable under the contract, the balance will be charged to revenue as an expense. Before recording impairment of any asset under the contract, the entity should recognize any impairment loss or asset related to the contract in accordance with the requirement of the other standards. If there are other standards that have any requirements related to any asset that is under the contract, you should first adhere to the requirements of the other standard. Next slide. Now, presentation and disclosures are given by the standard. These are to be presented and disclosed in the financial statements. As far as the revenue from contracts with customer is concerned, the core principles over here to take ahead is that one, it is basically control passed on to the customer rather than risks and rewards. There are multiple considerations to be done under the contract. There are critical 5 stages through which only you should recognize revenue, and in Ind AS 115 the way it is structured gives rise to a lot of complexities. That's the reason there is no standard accounting principle coming out of it. It always is based on the terms of the contract, the actual conditions, and the requirements of the standard. The complexity comes primarily from how the contracts will be modified, and a lot of industries will get impacted from the modification requirements, how the performance obligations have to be identified, and how the transaction price is to be allocated. Those are some of the complexities that Ind AS 115 gives rise to through the requirements. It's extremely complex, and that's the reason it requires a lot of study. For lack of time, I have not included a lot of examples in here. I had a lot of examples to give, but I couldn't include because we had to crunch it in 1.5 hours. But I've tried to explain the core principles of the standard. Standard is extremely lengthy. So just remember the core principles, and I think, the standard will be much easier to understand. Thank you very much.
Hi.
Hi.
Thank you very much for such a
Murtuza,
detailed...
the standard is so lengthy that you can't crunch it in 1 hour. Actually, it requires 3 to 4 hours to explain the whole thing. But I've tried to crunch it and talk only the basic main things about the requirements.
Right. See, unfortunately, we are also governed by a lot of regulations and the guidelines which ICI prescribes. And the ICI guidelines very clearly say that an event can be of 2 to 3 hours and one speaker only 1 hour. So that is what is a challenge. But no worries. So thank you very much for...
Manish Gadia, sir.
Yes. So may I now request my colleague in Regional Council, CA Manish Gadia ji, to present a hearty vote of thanks. Manish bhai, over to you. Manish bhai, you are on mute. Yes.
Yeah. Thank you, Murtuza bhai, for giving me this opportunity of proposing hearty vote of thanks. Before that, hats off to your dedication for organizing such a marathon webinar continuously on a daily basis. And thanks to Vajanti Wala madam, she has covered the lengthy standard in such a short time, as well as explained in a lucid language with some example, so that easily we can understand. So I request all the participants to carry vote of thanks with loud applause. Thank you.
Thank you. Thank you so much.
Thank you, Manish bhai. Let me also recognize and thank CA Hiral Shah for helping us in setting up this webinar, even CA Manish Gadia for helping us, and all the WRC staff, Subhash, Vaibhav, Mishra ji, Ravi Arora, Seema for helping in organizing all these programs every day. And thanks a lot, Vaijanti, once again. Thank you.
Thank you so much. Thank you so much. Yeah.